It is Friday, June 17th, here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Brian Sazi. We're taking a look at futures here this morning as we are gearing up for another very interesting day that futures are reacting to already right now. And as of right now, you still have the Dow Futures holding on to just 1 point. And I say that very strategically because of some of the comments that have come from Fed Chair Jay Powell just within the last 30 minutes here. And so we're going to continue to track to see where the futures point us. But we were up triple digits on the Dow earlier. Right now, S&P 500 futures, you're seeing those up by about 17 points, 0.5% there. And then the Nasdaq futures, tech-heavy average, still holding on to gains. But right now, only up by about 0.8% here. We've already seen a lot of activity here early pre-market.
Yeah, you thought we were maybe get a little bit of a bear market rally into the weekend, but Jerome Powell speaking at a Fed-sponsored conference just moments ago, that speech is continuing, really taking us down, to your point. I mean, it looked like we were going to get that rally, but alas, no go.
Yeah, Jay Powell saying, bear market rally, hold my beer.
Hold my beer. All right, here are 3 things you need to know right now. We're coming up on the final day of what has been a crushing week for the stock market as we officially enter a bear market. The Nasdaq has now lost a third of its value after peaking back in November. The S&P 500 could notch its worst week since March 2020. All this coming on the backdrop of a quadruple witching day as stock index futures, stock index options, stock options, and single stock futures are all expiring today. And Brad, that's all fine and good, but I think it is this commentary here by Jerome Powell just moments ago at this conference that really knocked futures, saying they are acutely attuned or acutely focused on bringing down inflation. Now, not new language per se. We just heard from Jerome Powell for quite at length this week at the Fed press conference, came out and raised rates by 75 basis points. But this is a major red flag, I think, to the bulls, because it gives you a sense of what might come as other Fed speakers come out and hit the circuit over the next few weeks. More tough talk on inflation and maybe more volatility for markets. And look, this has really been Jerome Powell's headline week, right? 75 basis points. That leaked just ahead of the decision to come as well, or ahead of the meeting actually beginning. And so we already had a sense of what was going to take place and what could come out of the meeting. And then it came back to the tone that he was going to be signaling in the press conference thereafter. And what did we hear? We heard more dampening down of a deep recession, but it still came up 8 times during that particular press conference. And even going on from here, you think about the GDP growth and where that's going to running below 2% through 2024. And so as we continue to move on throughout the rest of this year, you were taking a look through some of the probabilities. I don't want to look at that.
You don't want to look at the real GDP. You don't want to look at the probabilities.
It's just bad. It's just growth slowing down. And look,
yeah.
I got a good note moments ago from Matt Maley over at Miller Tabak, friend of the show, just consistently watching markets. And despite all of this concern on inflation and commentary from the Fed, earnings estimates on the street have actually risen. They have risen in recent weeks, and it goes back to what we've been talking about all week. This market is set up for a very disappointing earnings season because Wall Street, in many respects, is completely out to lunch. I mean,
for any of these companies right now, especially if you're in the retail sector where we've already seen some of the margin compressions take place in the landscape for ERP, that's perhaps been one of the only bright spots, but they still have, depending upon which company we're talking about, some of those foreign exchange headwinds that they have to consider. And so whether it be an international FX headwind that a company is taking on, or whether it be some of the margin compression because you have more or higher expenses on the back of a consumer that is trying to dampen down where they are spending and where some of those expenditures are going out the door because they are paying higher at the pump as of right now, that for this major scenario where we've already seen some of the downgrades in guidance, I don't know where, quite frankly, the upgrades are coming from for some of the expectations.
So unclear to me, but I would have liked to seen Jerome Powell come out here this morning and he talks about fighting inflation and you know what? Futures strengthen.
Yeah.
To me, as someone watching this market, that would have signaled perhaps a short-term bottom in the stock market. But the fact that he's coming out here continuing to warn about inflation, and you see futures come off the highs and weaken off of those comments, and tells you that not a lot of this is priced into stocks. And of course, we're in bear market territory across the major indices, but still, that type of reaction suggests this market is not prepared for what's likely to come economically over the next 3 to 6 months.
I think that's a consistent question that we'll be asking a lot of guests here throughout the course of today's show is how deep could this bear market be? What kind of bear market are we looking at right now? Switching gears here, President Joe Biden, speaking in an AP interview yesterday, addressed the state of the economy, saying that the American people are really, really down. However, he struck a more optimistic tone about a possible recession, saying, First of all, it's not inevitable. Secondly, we're in a stronger position than any nation in the world to overcome this inflation. For more on the president's comments, let's bring in Yahoo Finance's Rick Newman. Rick, just want to get your reaction to what the president had to say.
He did give good answers, but I think the problem is that he's being asked these questions in the first place. It's like the old saw about when did you stop beating your wife? He's giving the right answers. He's saying the way out of this is to project confidence. But the fact that he's getting these questions in the first place indicates the kind of political problem he's in. He's going to get more of this. The U.S. economy is not in a recession. I think it's important to keep reminding people that. We still have a very healthy job market despite inflation getting everybody down. But Biden is right about people being in a really foul mood. We have one consumer confidence survey that is at its lowest level ever. That is lower than it was during the financial crash in 2008. It's lower than it was after the September 11th terrorist attacks in 2001. So clearly something's wrong out there, and Biden knows this is political peril for him.
Rick, how does this play out for the midterm elections?
It's terrible for Democrats, and they seem to know it. Biden can do. He will do everything he can to try to convince people that things are still pretty good. Earlier this week, he said he's never been more optimistic about the outlook for the United States. But you can't talk people into feeling better. And this is almost entirely about inflation. And within inflation, I think it's almost entirely about gas prices. We've never seen gas prices around the country that start with a 5 before. And I think for Biden and the Democrats to have any hope of holding on to Congress in November, for sure, we need to get gas prices into the $4 range, and $3 would be better. I think people will feel like we're finally out of the woods when they see gas prices that start with a 3, and I don't think we're going to get that this year.
As we're seeing some of the inflationary pressures shift as well from goods to services, or in more so to services as well, during a heavy summer travel season, we've heard Secretary Pete Buttigieg, Transportation Secretary Pete Buttigieg, pressing airlines. So this more out of the administration, more out of the White House, particularly around what they're looking to do to try and help out consumers. But, you know, what is within these talks and what's actually going to come at the end of it?
There's just not much that the administration can do on its own. What might make a difference, or at least make it look as if Democrats are on the ball, is if they could pass some sort of legislation. And that there still is a chance they could pass, I guess, what you might call the remnants of Biden's Build Back Better plan, which might be some kind of green energy tax credits, but, perhaps very minimal social welfare spending. But honestly, at this point, people don't want to hear about green energy. They just don't want to hear it right now. People want to know, a lot of people are like, I get it. We need to address climate change, which is a very long-term problem. What are you going to do for me right now? And, here's what we're going to see. We're going to see Biden going over to Saudi Arabia this summer. What he needs to deliver from that trip is a tangible outcome in terms of more Saudi Arabian oil output. And there are some other things they're working on. There just are no quick fixes to this inflation problem.
And Rick, it doesn't sound like President Biden might be getting much support from the business community. A good survey, or a Dow survey, I should say, from the Conference Board out today, just looking at waning consumer confidence amongst the business community and the leaders that, in fact, are running these large companies.
Yeah, and in that survey, something like 60% of CEOs and business leaders say they do expect a recession in 12 to 18 months. I mean, guys, do you feel like I do? Let's just start the recession today. Let's get into it and get it over
Rick, I
with.
wonder if we're in one.
We're talking ourselves into a recession here, and we're not in a recession here in the United States. So one thing I'll say about that that Conference Board survey, that was a survey of global business leaders, and the economy in other parts of the world is worse than it is here. Europe may already be in a recession, and they are far more exposed to higher energy prices due to Russia's invasion of Ukraine than we are here in the United States. So Biden did say in his AP interview yesterday, said, we're in the United States, we're really in about the best position of any leading country in terms of our economy. He's right about that. But again, you're not going to talk Americans into a better mood by saying don't worry, other people have it worse. So we may be sort of the sort of cleanest dirty shirt, if you will, but this is just not going to persuade people that these are good times in America.
Well put as always. Yahoo Finance's Rick Newman. Thanks so much.
Bye, guys.
Okay, let's continue our discussion on this week's wild market conditions with Tony Crescenzi, PIMCO market strategist and portfolio manager. Good to see you here this morning, Tony. It's been a while. Look, we just got commentary from Fed Chief Jerome Powell moments ago saying they are acutely focused, that is the Fed, on fighting inflation. Do you think this market has fully priced in a more aggressive Federal Reserve?
We don't know, and that's the angst that the markets are displaying once again today and, of course, yesterday. There's a wide band of uncertainty regarding how high the Fed has to go in order to fix the current inflation problem. Market participants are quite confident that the Fed will ultimately be successful. In fact, as we know, there's an adage, don't fight the Fed, and don't fighting the Fed today means believing in its idea that the inflation rate will go down to the 2% objective that Jerome Powell, the Fed chair, mentioned today. The issue for markets and market participants is what it will take to get there. Currently, market participants think that the Fed will move to about 4% on its funds rate, add in the equivalent of about 100 basis points of tightening from its balance sheet reduction, $1 trillion per year, 3 years, equals roughly a point in terms of total monetary tightening. So 500 basis points of total monetary tightening is now built into market prices. And there's a substantial negative fiscal impulse this year, a $1 trillion reduction in spending, according to the Congressional Budget Office, to $5.8 trillion. That brings the deficit down 8 points to 4.2%. And the last component of this tightening is, of course, the pain that we're all experiencing in the financial markets. Financial conditions indices suggest the biggest tightening of financial conditions in magnitude in terms of movement since 2008, and perhaps on par or equal to, or greater than. The level of financial conditions could be considered still helpful to the economy, if you will. They're still not tight overall, but the amount of tightness has been severe. So there's a lot of uncertainty, a lot of tightening built in, but it's still not enough for the average market participant.
Tony, off of Fed Chair Powell's comments this morning, we've just seen the Dow turn negative here after being up triple digits. And so for the markets that are trying to price in all of the Fed speak that's been taking place, how far out are the markets looking, if we can put a timeline on this?
Well, I struggle to give an answer because there's even 1 month's data could change the view materially. We saw that last week with the CPI. It changed views materially. So did the University of Michigan Consumer Sentiment Index, which showed inflation expectations rising. It's something that the Fed chair mentioned as one of the factors that led to the 75 basis point increase. And so market participants will be on edge with those types of data, inflation data, for some time. So market participants are confident the inflation rate will come down. You see this in the inflation products. You see it in various gauges the Fed looks at, something called the five-year. There are numerous things that suggest market participants are confident, but it's the general public that has to be convinced in a Volcker-esque type of way, perhaps. And that's the worry. And if you did a search on Mr. Volcker, you'd see lots of stories about and references to Mr. Volcker today. The Fed chair, of course, tightened aggressively to fix the 70s inflation problem that many say is a result of lax policy from Fed chairs Arthur Burns and G. William Miller from 1970 to 78.
Tony, well, if we're back in a Volcker-like environment and we're seeing a period of stagflation, in this environment, where does that general public go to make money?
Well, we are all experiencing turbulence. Investors are experiencing turbulence, and we're all pilots to our portfolios. And what does a pilot do in an airplane when there's turbulence? Try to find smooth air. How does an investor do that today? Simply by taking a long-term orientation. You have to think about the various types of companies and sectors that one thinks will fare well in the years to come. And on the interest rate front, we would say that today's interest rate levels are quite attractive for fixed income and other investors. Think about the Bloomberg aggregate, a yield of about 4.1%. That's well above what's expected to be the inflation rate, at least according to Jerome Powell today, who said the Fed's acutely determined to get the inflation rate down to 2%. And let's say the Fed doesn't get it there and gets to 2.5 or even 3. There's a good cushion now, a real yield, as they say, a yield that's above the expected inflation rate. So an investor should take the long-term view and perhaps think about where they were a year ago when yields were in the ones and when they were dreaming of the idea of getting 4% on high-quality bonds. And so take the long-term view.
So for investors that are looking for that smooth air, particularly, we've heard from companies that are investing for the next 3 to 5 years in that next wave of growth. But in a recessionary environment, if you see cutbacks on spending or at least or even restructuring within some of these companies, and that retracts or retraces some of that vision that they had put out there and said we were going to be spending aggressively on, how vastly different do these companies look versus now? And going into the future, are they still going to be spending towards some of those larger goals?
Well, you're right that in the near term, there will be cutbacks and even verbal commitments on things will perhaps be scaled back. This is the normal human reaction to react to fear and anxiety, which is to retrench a bit. But ultimately, at least this is what's occurred for decades or even literally hundreds of years, the capitalist mindset will likely return. This idea of the profit motive and also the desire to live better. Think of Adam Smith in the 1700s in The Wealth of Nations, who said basically that people in desiring to improve the way of living would improve and increase the wealth of nations. And so you should put your faith in that, because we all want to live better and have better things and to make more money. And so that's still intact. And so there'll be certain companies, perhaps sectors, that don't make it out of this. That's part of the creative destruction process. And that's why it's really important to think from the bottom up as well as the top down in terms of the types of sectors, companies, et cetera, that will thrive in what we think is a very bright outlook.
Tony Crescenzi, who is the portfolio manager and market strategist over at PIMCO. Thanks so much for joining us this morning with your insight. We appreciate it. You guys, coming up, crypto crash. The crypto winter has just begun and it might be getting colder. Get your Parkers out. We're going to break down all the action from a very rough week for Bitcoin and friends. Next.
Breaking news, the FDA has authorized both Moderna and Pfizer's COVID-19 vaccine for kids under 5. Both vaccines still need final sign-off from the CDC, which is anticipated this weekend. Let's take a look at shares of both of those companies here in the early going, or I should say in the pre-market. Muted reaction so far, but indicating a higher open.
Switching gears, everyone, crypto has not been spared by the current market volatility. Bitcoin now trading at levels not seen since 2020. So let's toss it on over to Inez Ferre at the Wi-Fi Interactive for more on this crypto route. Inez, great to see you.
Yeah, great to see you guys. Well, it's been a rough week for crypto holders, as we've seen a Bitcoin that is lower this week. And it all really started when you had Celsius that halted the crypto platform, which halted withdrawals, transfer swaps of Bitcoin. You also had Coinbase, which announced that it was laying off this week 18% of its workforce, with CEO Brian Armstrong talking about a possible recession and a crypto winter. And then in the backdrop of all of this, you had, of course, Bitcoin, which is the flagship crypto. And Bitcoin, I'm just going to pull up a 10-day chart because we really saw over the last 10 days down 33%. A month-to-date chart, you can see it was around 31,000. Right now, it's at the just below the 21,000 level. And guys, this really goes to that point, and I know that Julie has mentioned this before, that crypto, Bitcoin, seen by some as it was being talked about a hedge against inflation. When stocks go up or when stocks go down, Bitcoin will go up. No, it has not proven the case. And in fact, when you see the Fed tightening its screws, all asset classes come down.
Yeah, indeed, they in fact have. Inez Ferre, thanks so much. And Brad, this is, when I talk to folks on the street, I don't hear anyone saying, I'm excited about crypto. I want to get in and buy this dip on crypto. I love that Coinbase is down 50, 60%. Let me back up the truck and buy this. I'm not hearing any of that sentiment out there. Nothing.
If anything right now, I think what we will hear is some of the major crypto bulls that are out there who have invested either in directly crypto or in some of the crypto touching platforms. They're going to continue to try and say, okay, even with this move lower, you've got to like the fact that a lot of the other speculative assets are going to get the rug pulled out from underneath of them and to create more viability. That could, by the way, create more viability for the larger market capitalization currencies, whether that be Bitcoin, whether that be Ethereum. And I, as I've always talked about in the past, a firm believer or bullish in the flippening, which is where Ethereum takes over the value of Bitcoin. I think still, even from this point, it's going to come down to not just proof of concept, proof of scaling is going to need to be next as well when you have even more people that want to tap into the blockchain. And this, I think, for one thing, in all of the downward movements, it gives people more of an opportunity to get educated on this and perhaps do even more due diligence than people do when something is on the rise, on the way up, and seeing some of these astronomical rises, because then it's just like, all right, a FOMO trade at that point.
Isn't that a movie, Bullish in the Flippening?
Bullish in the flipping?
Yeah, I think
it's no, if not, we're making it this weekend.
I'm making the joke. It's Friday. It's Friday. That's what we're doing. Markets under pressure. That's what we're doing here. All right, coming up, Adobe has the hottest ticker page on Yahoo Finance right now. We're back with the details next. Shares of Adobe are under pressure this morning after reporting mixed earnings and a worse than expected outlook. And Brad, a couple things to pick apart here with Adobe. And as I mentioned, it's also the top trending ticker on the Yahoo Finance platform this morning. They lowered their guidance for its current fiscal year by $250 million. And they're pinning the blame on FX headwinds, just like Microsoft we've been talking about all week. Another big cap tech company warning about the revenue and profit hit from various foreign exchange moves. Also a $75 million hit from the Ukraine war. I have to knock Adobe's executive team here. You know, I listened to that earnings call, and there was really no acknowledgement of what is happening in the world. And right now, for me, I'm giving high marks to executive teams that are hopping on these calls and various investor presentations out there on Wall Street. They're all happening over the next few weeks still, that are keeping it real.
Yeah.
You know, I understand DocuSign CEO Dan Springer, he came on with us last week, challenging quarter. He told it like it was. You hopped on this Adobe call, and it sounds like a bunch of executives that are setting their investors up for failure when they report 3 months from now. You would think GDP was growing 6 or 7%, and consumer spending was going through the roof, and interest rates were still at rock bottom levels.
Yeah, and there is that realism in the forecast versus the actuality of what they're trying to redirect towards. And if there's anything, they're trying to ensure that, and all of these companies, when they're continuing to invest in some of these core categories like digital media and net new digital media, that all sounds great. But at the end of the day, when we boil down to how they're going to continue, even in this environment, to see internationally, as we were just talking about a moment ago, Europe possibly already being in a recession, how does that dampen what your outlook looks like and where you're actually going to see some of that continued run rate from this point forward if businesses and end consumers, which is what this company dabbles in both sides of that, B2B and B2C, if they're getting hit on both of those ends.
No, right on. And you know, I can't help but to think if they would have read the room right, use this type of environment to just keep it real with your investors. We all see what's going on in this world, various inflationary pressures, consumers pulling back, and businesses also pulling back on how much they do spend. I understand digital opportunities are amazing, and you want to position yourself the future of cloud services. But you know what? Businesses are in fact pulling back. And then I look at the valuation of Adobe. It's not priced for recession. It's still trading at almost 30 times forward earnings, according to data on Yahoo Finance Plus, a PEG ratio of almost 2 times. And again, this comes as slowing growth starts to set in at this company.
There will be companies over the course of this next earnings season that will be extremely real with us, and there will be those that are almost overly real to the point where it seems like they might be sandbagging even in order to just beat on some depressed kind of outlooks as well.
Yeah, well, here we're coming up against that opening bell on Wall Street. What could be a very interesting trading session in light of new commentary Fed Chief Jerome Powell. There's that opening bell. And there you can see over at the Nasdaq, I have to give a shout out to the team at Nasdaq. That is in the first opening bell, I believe, in the metaverse. So that is you are looking at a potential future for opening bells here, at least over at the Nasdaq. That is an opening bell in the metaverse. And Brad, I've truly seen it all. I lived through the great financial crisis. I watched values of bank stocks get wiped out 70 to 80%. Now I'm sitting here today with you, my friend, watching an opening bell essentially in a video game. Okay,
so you know I used to work in that building every day. Not this one. I wonder how much that real estate costs in the metaverse, because we know some of the spots in Decentraland are coming in pretty high.
And probably more money than you and I have. Of course, this opening bell sponsored by our friends over at Flex Shares.
All right, switching gears, everyone. Let's talk a little bit about travel here, even as we're opening up the markets here on the day. The Dow Jones Industrial Average, you're seeing that open lower by about 25-ish points there. And then additionally, we saw the Nasdaq and the S&P 500 just barely holding on to some gains right now. Also taking a look at some of the travel sector stocks, airline stocks, they're holding on to gains this morning as summer travel demand is in full swing, but with rising inflation and ticket prices already sky high, how long will the demand last? We may have seen it start to show yesterday as airline stocks, they did fall yesterday, but the broader markets were down extremely.
Can I just go back into that metaverse? I just want to go back into the Nasdaq metaverse.
Yeah,
it's been a long week. I just want to get back in there. But look, I've been watching these travel stocks all week long, and it's getting really, really ugly. But let's zoom out a little bit here. Let's look at the 1 month chart for some of these names. Delta down 17%. I've got Carnival Cruise Line down 40% in a month. You have Norwegian Cruise Line down 31%. There's a couple of things going on here. One, all these companies have large, sizable debt positions on their balance sheet. And when you start to think about recession or go into one, that is the last place you want to be, which could come at a time where consumers are pulling back. So your top line sales are slowing down at a time where you have significant debt commitments coming outside of coming out of the pandemic is not exactly a recipe for stock price appreciation. And then, look at the airlines too, and a good pricing study over at Adobe. Their most recent data showed prices for domestic flights in May up 30% over 2019.
Yeah.
That's a huge increase to the point where you have to wonder, do consumers start to pull back on taking a trip here when you have prices up by that much?
Well, let's talk about some of the macro effects around this. And some of them overlap, some of them don't here. Specifically, when you talk about Carnival, cruise lines, or any of the cruise line operators, and then also the fuel prices that they have to take on, as well as the airline operators do, and those costs getting passed on through consumers. Consumers are seeing higher ticket prices, but then once they're in the experience too, they're going to see higher prices for everything that they're paying for just to have the fullness of that experience economy within the cruise line operator or even within that flight that they're taking as well. Now, the difference is here, operationally wise, for cruise lines, they were in a period of re-engagement, trying to get passengers back on. For the airlines, what we had already heard earlier this year was that they were seeing leisure travel demand start to tick up, and that business travelers, when they came back, they were going to be competing with the leisure travelers. So as long as that remains intact, and there's a question of if there will be some at least modest demand destruction in this current quarter and then even in future quarters because of what those same customers are impacting elsewhere when they're moving about the country, or even just when they're purchasing groceries or gas on a day in, day out basis, how that will have a knock-on effect on some of those other travel experiences as well. We didn't even get into the accommodation space, which is undergoing its own type of, I think, headcount overhaul, also just the type of experiences that they're bringing into some of those different stay packages as well.
I did find where flights are free. They're in the metaverse. They don't cost anything in the metaverse. Yeah, I'll send you the link. You can sign up for it.
Done deal. Cheap flights.
All right, shares of World Wrestling Entertainment, another stock that's going to be in focus today after news that Vince McMahon will be stepping down as CEO while the wrestling company's board investigates him for alleged misconduct. In the meantime, his daughter, Stephanie McMahon, will serve as interim CEO and chairwoman. You can see the shares down slightly here in the early going. Look, this comes after an extensive report by the Wall Street Journal a couple days ago, but worth keeping in mind here, I think, two things. One, Stephanie McMahon is running the company. Obviously, that is Vince McMahon's daughter. So if there's any positive here from an investor standpoint, at least she understands the company and what it has done in the history of the company. And then, but secondarily, look, they still control the company. The Journal story early in the week goes through great lengths explaining that he still controls voting power of what ultimately would happen to this company. So just because Vince McMahon is leaving as CEO, he's still retaining his creative role inside the company, which one that he has valued for many, many years. Don't expect WWE to come in here and somebody to buy the company or be sold. It still runs to the McMahon family.
There's a lot of other considerations, too, in terms of the partnerships that WWE had been able to take on over the course of this year, whether that be new individual partnerships on the name, image, and likeness front. Do you see some of those partners start to back out? Do you also, across some of the corporate partnerships, whether that be in streaming or gaming, where WWE, and I don't know who's gaming and gambling on WWE, but for all the partnerships that they've seen come about, where do you start to look across those? And in the midst of this and in the wake of this investigation, do some of those start to kind of pull back on, what they had charted going forward for the eyeballs, the impressions, and the reach that the WWE was looking for? But that is just one of the impacts that they have to consider here. And it'll be interesting to see how Stephanie McMahon, who's taking over in the interim position and capacity right now, navigates all of that.
And, of course, the television deals, too.
Massive.
Yeah, massive indeed. Well, all right, switching gears, or actually just staying on entertainment here. Shares of Disney haven't been very happily ever after. Shares are down about 10% this month. This comes as the highly anticipated Toy Story spinoff Lightyear hits theaters today. Brad, I don't know if I'm going to see this one.
I'm going to see it.
But nonetheless, look, Disney is in focus here because vacations are starting to get more expensive. And you look at some of the recent analyst commentary by The Street, they are reporting that attendance is starting to weaken a little bit, not falling off a map, but an already expensive Disney trip is getting a lot more expensive. And I think you're at that point where you're having a lot of families wonder, do they need to go to Disney in this type of environment?
You know, what Jurassic Park proved last weekend is the film doesn't even have to be good, and you'll still probably do well at the box office. And what's gotten people back to the box office? Dinosaurs, Marvel superheroes, Batman, and maybe Buzz Lightyear.
Yeah, look, you really get the sense that Disney could be dealing with a lot of just negativity. You have Bob Chapek, who's under incredible pressure to turn this company around, and it has not happened. His tenure as CEO has not lived up to expectations. And the last thing Bob Chapek at Disney, the CEO, needs is a recessionary causing pressured traffic at his various parks.
The parks is the world that he came from, right? And so you would hope that in navigating a recession before, that he would be able to kind of glean some of that know-how and that insight. But I think at the same time, in some of these other divisions where, sure, he's been annexed to it because of the brand, but when you're directly thinking about merchandise, if merchandise pulls back, if you're directly thinking about the number of streaming customers that you have, and them not opting up into some of those higher tiers, and then you get into the box office side of the business, if people don't go to theaters, those are all direct headwinds that they're going to have to consider in this immediate term. Guys, coming up, recession stress. While Powell makes moves, Biden tries to calm things down. We've got more on the growing stress for the average American ahead.
With layoff announcements picking up and the stock market tanking, people are growing increasingly worried about a recession, as our nifty chart of the day shows. Google search data shows volumes for recession are tracking to be as high as March 2020. Search volume for recession is also tracking at levels seen during the Great Recession. Again, you can see those spikes there really picking up in terms of search volume. All right, straight ahead, with consumers being drilled by higher gas prices, we'll take a look at next how much spending could be in fact pulling back. We'll also get a read on the latest market conditions. We'll be right back.
Welcome back to Yahoo Finance Live, everyone. Markets are holding on to some gains right now, and the Dow is up by about triple digits, 0.5%. Let's also get on over to Yahoo Finance's Emily McCormick with more on the major averages and what we've been tracking very early on in today's tape. Emily.
Well, Brad, we're seeing a bit of a reversal from the market moves from yesterday. And if we head over to the Yahoo Finance Interactive, you can see clearly that the S&P 500, Dow, and Nasdaq are firmly in positive territory just about 15 minutes after that opening bell. Now, if we do look over the past 5 days on the S&P 500, you can see that that index is still down by about 5.2% for the week. As of yesterday's close, the index had been down about 6% and was on track for its worst week since March 2020. But it looks like we may narrowly avoid those levels and that interval, of course. Now, if we take a look at the Nasdaq 100, again, a different picture from what we saw yesterday. A lot of green across the screen with only a couple of components here in the red. A big reversal from what we saw yesterday, whereas this screen was mostly red with just a couple of spots of green in intraday trading. So certainly some bright spots here when we take a look at that trading action. Also want to highlight what we're seeing in terms of the sector action in the S&P 500. As we can see, energy is the only of the 11 major components that is trading lower this morning. And then if we head over as well to the Chinese stocks, big reversal there as well. Alibaba, of course, one of the big standouts moving higher after Reuters reported that the People's Bank of China was going to be approving Ant Group's move to create a financial holding company. So yesterday we certainly saw a big risk-off move in these markets, seeing a little bit more optimism, a little bit more of a bounce today. We'll see whether this ultimately holds. And again, still heading for steep weekly losses, guys.
Yeah, glad you mentioned Alibaba, Emily. It is now the top trending ticker on the Yahoo Finance platform. Emily McCormick, thanks so much. Okay, there's a lot coming at the U.S. consumer right now. Gas prices over $5 a gallon. Food prices through the roof. Fears of a recession starting to take hold. Pull all this together, and we could be looking at a consumer spending pullback in the months ahead. Let's chat more about this with MasterCard's chief U.S. economist and friend of the show, Michelle Meyer. Michelle, happy Friday to you. Look, as I just said, there's a lot the consumer's dealing with right now. Are we at that point where consumer spending could just fall off a cliff?
Hey, Brian, thanks for having me on. Always good to chat with you. Yes, the headwinds are blowing very strong right now. There's high inflation. There's high inflation necessities, food and energy, as you noted, and shelter. At the same time, the Fed is trying to fight that by hiking interest rates. So there are headwinds. We do need to pay close attention to it. And there's surveys are suggesting that consumers are noticing as well. That said, when you look at the actual data, when we look at MasterCard spending pulse data, the consumer is still out there spending. We actually saw an acceleration in the year-over-year growth rate in May relative to the prior month as consumers get ready for the back-to-school season. So there are challenges. We should expect a moderation looking ahead, but by no means are we seeing anything that resembles a collapse in spending here.
Michelle, you've been doing this for a while. Are you surprised we haven't seen a sharper pullback?
You know, I'm not, for a few reasons. The first is look at the labor market, right? We still have very high job openings rates. We still have very strong job growth. The last jobs report showed 390,000 jobs were added across industries. The unemployment is very low. Wages are rising. So there's support in terms of that fundamentals in that people have jobs. They expect to continue to have jobs. The other very, very important factor is that they have savings. Right? This last year was one of extraordinary stimulus, monetary stimulus, fiscal stimulus, and that created a lot of cash on balance sheet. And those cash levels are still high. So people have the ability to use that to help to finance spending. So what we're seeing in kind of the simplest form is a reversal of that real excessive stimulus, right? We're seeing that pullback. We're seeing an attempt to rebalance the economy. And that does mean a moderation is going to come, but it doesn't mean that it has to be this abrupt change in the course of the economy.
Michelle, do you believe that supply chain issues will be, and these have made inventory levels extremely unpredictable for some retailers, do you believe that they'll hold up to a necessary standard or at least a level that will make it stable enough to meet some of the spending pulse goals and targets, at least in forecasts of 7.5% growth during the back-to-school season?
Yeah. So the supply side is critical. And I'm glad you brought that up because it's not just when you think about the economy, it's not just how much consumers want to buy, it's how much is available there. And this has been a major challenge in the past year to 2 years is that supply chains were limited. They were broken for many items, and inventory levels fell to very low ratios, and as a result, prices increased dramatically. The good news is that that's starting to be resolved for certain products, and in fact, you do hear some retailers that have had, just in case inventories actually sitting on some decent stockpiles now. And in the end, that can maybe even lead to some disinflation, which would be really quite welcome given the inflationary pressures that are out there. So I think that there is product available now, more so than certainly a year ago at this time. Remember also that consumers have shifted their prioritization around spending. You're seeing a lot more experience-based spending, travel, restaurants, lodging, and you're seeing the items that go along with that. So kind of occasion apparel, for example, where people want to buy certain items in order to experience life again and get back out there. So there's differences in the consumer wallet. The story's going to look very different depending on what sector you're focused on.
Michelle, just a follow-up to that, because as we're thinking about how the retailers themselves are kind of navigating this environment, the operating costs for the sales that retailers are banking on, they're vastly different than they were this time last year in terms of the 2019 comps. And so all of that considered, from your perspective, is there an outsized risk of some margin compression on their front if they have to discount at the same time that they are going into the back-to-school season, even in the holiday season?
So I think the challenge for retailers right now is to be as nimble as possible in terms of responding to consumer demand. Everybody was caught off guard right when the pandemic hit, and people wanted to snatch up as many goods as they could, big ticket items, everything related to housing. And there was a major shortage and we couldn't accommodate that demand. And now that has changed, right, where there's a lot more spending related to leisure and again, this kind of experience economy. So it's about being nimble. It's about being able to respond to these changes in consumer behavior and being able to realize where, and how you can pass on costs. So, the consumer is the pulse of the U.S. economy, and trying to understand what's happening in real time, I think, is critical.
Michelle, do you think we are talking ourselves into a recession? I realistically, this weekend, President Biden's comments to the AP in his latest interview about a recession and things slowing down, that's going to be played all over the place over the next few days. Yeah. And if you see those headlines, maybe you're just less inclined to not go out there and buy a new shirt.
Yeah, so I like the Google search chart you pulled up. I look at that myself because I think it is important to understand kind of the buzz, right? What's the animal spirits out there? How concerned are people? Because when they hear about recession, they start to wonder. But at the same time, they're also looking at healthy income. They're looking at money out there. And they're still trying to, resolve some of this pent-up demand that they've had for a long time. So, animal spirits matter. Behavioral economics is really important. So we do have to think about these sentiment changes and how people are perceiving the economic environment. But also what they're getting in, right? Income in means a certain amount of spending out. So to me, the recession story, I think it's smart to be thinking about these headwinds. I think it's smart to be thinking about the path of the economy looking forward. And a lot of these recession calls are about 12 to 18 months forward. I think it's hard to say a recession is around the corner. We're just not at all seeing that in the data. But to say that there could be some considerable risks into the future, absolutely. We should be thinking about that. You have a real pivot in the economy with the Fed hiking interest rates dramatically and trying to cool down the economy to rein in inflation. But we have to be careful with how we characterize these recession risks, in my view.
Michelle, always great to get your insights and perspective. MasterCard's chief U.S. economist, Michelle Meyer, thanks so much.
You got it.
All right, guys, and coming up, Barbie and Ken.
That's me. All right, I look great.
They popped the picture up, and I
slimmed down great.
Yeah, looking good, Sauce. All right, Barbie and Ken, they're coming to life, but can they save toys? The challenges facing the industry ahead. Woo. U.S. toy industry unit sales, they declined 6% this year from January to April, according to a recent report by the NPD Group. The toy industry feeling the effects of a challenging economic cycle as recession fears loom. So what's in store for the sector moving forward? Sazi's take hits the toy chest today, Saz.
That was my pet, my bear in that picture, if anyone was wondering. His name is Ticker. But look, we've been all morning long focused on the potential of a recession, what people are spending and what they're not spending. And I would say this MPD data, which runs from January to April, and some most recent data just came out, another way of looking at it is year to date, is a red flag for the state of the toy industry, which had been doing well through the pandemic. You look at unit sales, like you mentioned, Brad, down 6%, average selling prices up 7%. So what is essentially happening? The likes of Mattel, a Hasbro, a Funko, their costs for producing all these toys, they have gone through the roof in large part because of supply chain bottlenecks. They are now in the mode of pushing through price increases for consumers on a category that has historically been very price just sensitive. And you're seeing consumers perhaps starting to pull back. And again, as a red flag, because of, as you know, we're not too far removed from the holiday season. It's going to come quick. It's going to come fast. Everybody's going to go out there and buy some toys. That said, there are some bright spots here in this data. Collectible sales up 28% year over year. Within that, traditional plush toys up 43%, led by Squishmallows, which we talked about recently because they're sold and they helped the quarter out of Five Below. Disastrous quarter by Five Below, but one of the bright spots for them were these Squishmallows. Just fascinating, simple
We're
to make.
Squishmallow bullish indicator.
We are, very bullish. But also Funko Pop, and you like this. I know you're a Lego guy.
Big time.
Building sets up 7% year to date, led by Lego Star Wars and traditional building sets. So Lego sales are doing well. But overall, my take is this. It's going to be hard, I think, for a lot of these Mattel, the likes of Mattel and Hasbro, to push through even more price increases on consumers that as they get over the head with inflation in food and gasoline prices, it's going to be hard, I think, for them to put forth a robust holiday shopping season. Of course, there you see my pet bear, Ticker, frowning.
It's like your teardrop tattoo as well. Here.
Oh, wow, boo.
Killing the toy season, huh?
That's brutal. That's brutal.
All right, so right now, Legos, yeah, you know I'm a huge Lego fan. Yeah. All right, so what does this spell out? I mean, merchandise right now, even if households are pulling back on some of that spending, then what categories are they going to lean into? What is like the most resilient of the toy category, does it seem?
It seems to be those very, at least from a toy perspective, those very approachable, simple toys, like a Squishmallow. It's an attractive price point. It's somewhat affordable, and it brings you what appears to be endless amounts of joy and relaxation. Maybe I need one of these things.
Okay, we got to talk about Mattel Barbie. I mean,
Ryan Gosling.
Yeah,
okay. Look, this one caught fire, and there's
from the movie. We should
yes,
say.
there is a stock angle to this because we've talked to Mattel CEO Anand Krais at length, and he has put a whole bunch of new movies in the pipeline, looking out over the next few years. Now, this Barbie movie, you can see Ryan Gosling there showing off his chiseled abs, looking like an old school Abercrombie & Fitch model. But that movie is supposed to hit later. That is supposed to hit later this year, and there's really no resemblance between myself and Ryan Gosling, but still, it's nice to imagine. That Barbie movie is supposed to hit next year, and it could lead to strong sales for Mattel because it is out there making this movie, putting it out there, but also, obviously, dolls and various other figurines and sets.
You use the Peloton bike. Do you think he uses the Peloton guide?
I think he's using some stuff from GNC, maybe a little Peloton bike and maybe that Beyonce diet.
Can we do the side-by-side picture again? You got to make the same facial expression.
You're going to make me do it.
There it is. That's close. That's
why they pay us big bucks, Brad.
There we go.
We can do that real time.
Guys, coming up, the best of the worst, why despite the pain at the pump, you should be thankful for filling up your tank in the U.S. That's next.
Welcome back to Yahoo Finance Live. I'm Brian Sozzi alongside Brad Smith. Julie Hyman is out on assignment. Limping into the weekend, that is the vibe on Wall Street. After a brutal week for the markets, we are seeing some tepid buying across the board with the Dow in the green, the S&P 500 and Nasdaq also clinging on to modest gains. Now, here are three things you need to know right now. Crypto carnage. We'll dive into the outlook for the crypto complexes. Everything from Bitcoin to Coinbase to have been routed this week. Right now, Bitcoin prices are clinging to that $21,000 level. Tech wreck. Crypto isn't alone in having a tough week. Tech stocks have also continued to be hammered on fears of much higher interest rates, but there are some names that you should be perhaps looking at on weakness. We'll explore just that. And with the NBA Finals all wrapped up, we'll talk to an analyst from Macquarie to break down the sports betting world. But back on the economy, from rising rates to falling stocks, it's been a wild week for both the U.S. economy and Wall Street. Our next guest says while the Fed's aim to bring inflation under control is necessary, it may feel like the cure is worse than the disease. Joining us now is Beth Ann Bovino, S&P Global Ratings Chief U.S. Economist. Beth Ann, always nice to get some time with you. Look, it's been a wild week here for the markets, for the economy. As we look out to the rest of the June, where do you think we might see the economy head?
Out through this month. I mean, this month, I think things are going to hold up relatively well. We are starting to see signs that consumers are pulling back, and that's not just on low income households. You're starting to see, well, you mentioned the crash in the equity markets. That usually has an impact on the wealth effect, affecting higher income households as well. So we expect to see that slowing down. But generally, the U.S. momentum in the economy at this point in time will hold up. Doesn't mean it'll last forever, and that's where we're concerned going into 2023.
Beth Ann, markets will typically price in a recession prior to it actually showing up in the economic data. But a question particularly is how deep of a recession might markets be trying to price in?
I would say that, markets are fearful, understandably. We're talking about the Fed moving much more aggressively than that they had earlier indicated. And indeed, they came out with a 75 basis point rate hike without giving us any guidance beforehand. So that seems to say that the Fed's scared. And when the Fed's scared, the markets are scared, pricing in a much more aggressive Fed policy. And that means an aggressive response to a recession. Now, whether the markets are right or wrong on the recession remains to be seen, but there's a lot of headwinds. Now, we see the risk of a recession increasing rather dramatically. We had it at 35% for 2023. It looks like it's climbing higher, but the size of the recession is the real question. And given we do have buffer both with the household balance sheets and business balance sheets, we suspect that the recession might not be as severe as markets fear right now.
What is that ultimate trigger point, Beth Ann, that tips us into a recession?
Watch what the consumer does. The consumer makes up, close to 70% of economic activity. We're watching them. It looks like they've blinked, and there's understandably so. When you have food and fuel making up the biggest size of the consumer basket, meaning there's not much left to spend on discretionary items. You mentioned toys. I felt bad for the children, but that might be one area that's cut, and that means that when people stop spending, the economy weakens. I also watch as a near-term indicator what happens with the jobs front. Those initial jobless claims numbers is a leading indicator according to our business cycle barometer, and that's something that we're keeping a sharp eye on.
Even with his comments this morning, Fed Chair Jay Powell tossing a big question mark into today's tape, and we've seen that play out as the Dow has kind of waffled in and out of negative and positive territory. With all of this in mind, this week for the Fed in aggregate, the recession concerns that have been brought up within the conference call, this is the same committee that said inflation was transitory at the end of the day. Did Wednesday's decision and the press conference do enough to, I guess, alleviate some of the credibility concerns coming into this FOMC meeting?
I think the Fed will hopefully be able to pull back the reins and get control of the narrative. But right now there is a lot of there's a lot of challenges they face. They also noted in that press conference that indeed a lot of things are out of their control, and that's true and understandable. Meaning that their tool is basically interest rate policy and monetary policy, which affects demand. They can't control the supply chain response, and that, while it's very true, it's certainly not very comforting for markets, I believe.
Beth Ann, how damaging is it to consumer wealth if gas prices stay above $5 a gallon looking out into the year end?
I think that on the low end of the income bracket, food and fuel, particularly food, which is at as you mentioned, a new record high, is going to squeeze the low income households. We saw it before. It was that if you look at disposable income, again, this is from 2019, and it's gotten a lot worse since then. We saw that about 12% went to energy spending. For high income households, it's a lot lower. It's closer to 2%. This goes back to 2019, but it's still about the same. It's all gone up because of these prices. That means less money for these households to spend, and that's a real squeeze. You mentioned the equity crash. We're in a bear market now, that also is a leading indicator for recessions as well, if it lasts long. And right now it feels like it will.
Beth Ann, always great to get some of your time and really discuss what some of these macro impacts are and what everybody's navigating through right now. Beth Ann Bovino, who is the S&P Global Ratings Chief U.S. Economist. Thanks so much for the time. Have a great weekend. And every American is feeling pain at the pump, but we actually may not know how good we have it compared to other places in the world. Yahoo Finance's Inez Ferre joins us now. All right, Inez, how good do we
Sell
have
this one?
Right, that's right. And this may be little consolation, of course, for consumers here in the U.S. that are paying $5 a gallon for gasoline. But look, if you take a look at other places in the world, particularly Europe, you are seeing gasoline or petrol prices higher than here in the U.S. And part of that has to do with the tax system in Europe and the heavy taxes that you have on these gasoline there in these European countries. But look, Germany's paying north of $7 per gallon. Of course, they go by liters, but when you convert it to gallons in US dollars, these are the prices. France, Italy, Spain, UK is paying more than $8 a gallon. You've got Norway paying more than $10 a gallon, and Hong Kong is paying the most, more than $11 per gallon for gasoline. Europe has the issue of that's even worse than here in the US with this energy crisis, because they're also paying nosebleed prices for natural gas. And now Russia is tightening the screws on supplies into some European countries. The feeling is that what analysts have told me is that as you see these energy prices high in other parts of the world, you may see other parts of the world first go into a recession, if we are talking about recessions here, before the U.S., and particularly Europe, because of these really high energy prices.
Well, if anything, Inez, I think that chart just reminded me, should we get some form of hurricane and that pressure is oil, we might be seeing Norway-like prices here. But look, gas prices have come down a bit, though, recently.
Yeah, they have. Here in the U.S., we are seeing the national average for gasoline now at $5 per gallon. A couple of days ago, it was at $5.02 a gallon, so down 2 cents. Some analysts are saying that in the next few days, you could see it come down even more, maybe slip around 5 cents or so in the next few days. And part of that has to do with gasoline futures that are lower. But look, if you take a look at diesel prices are still at all-time highs. And as far as supply is concerned, diesel is the shortest supply of refined products around the world. And diesel is heavily used here in the U.S., in Europe, in Asia, all over the world. So you are still seeing very high prices for energy.
I'll be right back. I'm going to go fill up my cart. Down 2 cents. That's great. See you guys later. No, all right, that's great. Thanks so much. That's not bad, though. 2 cents. All right, before we head to break, I want to highlight a big call on bank and card stocks by Baird. Baird analyst David Jordan says a buying opportunity has formed in shares of American Express, Capital One, Fifth Third, and M&T Bank. Says George, relentless panic selling has provided an opportunity for investors with the risk reward finally looking attractive for banks and car names. George adds he believes the valuations on these stocks reflect more than enough macroeconomic risk. Coming up, as Snap shares sinks, even Evan Spiegel and company want you to pay up. The details on the company's subscription service straight ahead.
Welcome back, everyone. Celsius is taking heat as regulators across several states open investigations into the crypto lender's decision to suspend customer redemptions. Celsius had paused withdrawals, swaps, and transfers between accounts, citing extreme market conditions. Celsius, of course, one of many crypto-related companies suffering after crypto markets cratering over the past few months and weeks, actually, here. The investigations into Celsius are being pursued by regulators in Alabama, Texas, New Jersey, and Kentucky. Social media giant Snapchat is currently testing a paid tier for a now called Snapchat Plus that gives users additional functions like pinning a friend as your #1 BFF, exclusive Snapchat icons as well, and you can see who rewatches your stories. The move comes as Snapchat tries to redefine itself in a shifting advertising landscape and in the wake of an overall tech sector downturn. Snapchat, which traditionally made most of its money through targeted advertising, has been recently forced to adapt as platforms like Apple make a bigger push for privacy. And a big win for the Golden State Warriors, or the Oakland Warriors, or the San Francisco Warriors. Well, the Warriors won. They won the NBA Finals. They beat the Boston Celtics 103-90 on Thursday, clinching their 4th title in 8 seasons. Steph Curry helping wear down the Celtics and snagging his own place in NBA history with the Finals MVP in the process. I know Saz would say, ballin'.
Yes, that's exactly what I would say. Thanks, Brad. Okay, the sell-off in Tesla shares looks ugly any way you slice it as investors shun high multiple tech companies. Tesla stock is down 8% in the past 5 days, 12% in the last month, and off by 40% year to date. Let's bring Yahoo Finance senior auto correspondent Praz Subramanian here for a chat on this Tesla route. Wow, Praz. And I say wow because Tesla's been doing pretty well.
Yeah, it's not necessarily a fundamental story, size. Just a lot of just kind of bad headlines over the last 6 months, right? China shutdowns. This is no particular order here. China shutdown sending supply, right? You have the German Giga not supposedly fully ramped up, right? Autopilot investigations, right? This big overhang with NHTSA kind of going after Tesla on these crashes at these emergency sites. Ford and Rivian beating Tesla to the electric pickup truck, right? Tesla's not out yet.
There's no Cybertruck.
Yeah,
come on.
Bitcoin and crypto getting hammered, right? Tesla has a lot of Bitcoin on the balance sheet that can be an impairment in next quarter. And then the question is Elon distracted, right? You talk about Twitter, you talk about getting involved with politics, getting involved with SpaceX and Boring Company. These are all these things that are kind of taken away from the question of Tesla performing right now.
Okay, well, the Cybertruck is going to be in the metaverse. We saw that. It was actually in the background of the Nasdaq opening bell today. Yeah. But let's get back to Musk and going after Twitter and via an acquisition here, and what that's done to Tesla shares as well here in tandem. Because if we go back to the beginning of April, where this started to get disclosed, there's a really stark kind of reaction that we've seen from both of these companies' stock and the price action there.
Yeah, every time you hear about the Twitter deal kind of going on the rocks, Tesla gets a little pop, right? Because this overhang of, is Elon, how many shares has he got to pledge to make this deal? Any kind of margin situation going on with his holdings of Tesla stock, which are tremendous, right? But I got to go back to that, but the Tesla fundamental story size, what hasn't really changed? Demand is through the roof and they're supply constrained. You said that for many quarters in a row. You have people buying more and more EVs, and in Q1 we saw that doubling compared to last year. Gas prices are high. So a lot of these fundamental stories for the company are pretty good. So maybe there's a silver lining here going into Q2 earnings for them, because that has not changed.
You're a well-known auto reviewer. I'm always reading your reviews, Praz. And do you think Tesla has to pick up its quality game? I've been recently running around in some Teslas, and obviously, of course, look, they're nice. I get it. I totally understand the fascination with them. But this next wave of EVs that has come to market, notably from high-end makers, is really calling into question if Tesla can keep the quality where it is. It's not where it needs to be.
I think there's so many facets to that question, right? Because you have initial fans, they don't care, right? I love Tesla. I don't care, but the quality car is great. As you get more and more people marginal buyers want to come in, I want to try Tesla. Why is the door panel falling off? Why is there squeaks and rattles everywhere? That could be a problem, but I just see, initial customer quality stuff is still pretty high for them. So you have this data there, but they also have a lot of anecdotal pieces of news where people are really disappointed in the car.
Polestar just came out. I reviewed a Polestar, incredibly impressive vehicle. I guess that's because of the attachment to Volvo, but still, there's a noticeable difference between a quality of a Polestar, which is not exactly upper end or luxury, compared to a Tesla Model 3.
Yeah, 100%. Even a Kia EV6, every panel gap is the same, uniform. Everything, there's no squeaks and rattles. Everything's fit and finished perfect. Compared to the Tesla, there's a lot of kind of, quality issues, you might want to call it, but it doesn't matter to their fans for some reason.
Does Tesla, in their operations, the raw materials constraints as part of the broader supply chain, does that force them to then look to alternative suppliers, source materials elsewhere, and how does that impact quality, to Sazi's point? Yeah,
I think that's sort of the big question going forward. Tesla is famously very vertically integrated. They have a lot of their suppliers that are on board for many years, and they also have a lot of forward contracts in place. So a year from now, what happens when the chips do run out? And then everyone's competing for the same battery materials, and Elon's saying we need to buy, the lithium directly from the miner. So that's, I think, this is the play, right? Is do you believe in Elon and a management company there to actually go through that in the future, or do you bet on the Fords and GMs of the world who have been doing this for 100 years?
Not at the same time while he's trying to reinvent Twitter would be
right.
Pras Subramanian joining us here. We appreciate it. All right, guys. Let's take a quick look at the markets here as we are just inside an hour of trading here on this Friday. And this market check is sponsored by Flex Shares. You're taking a look at some mixed activity here. The Dow Jones Industrial Average right now down 0.25%, 78 points in the red. The S&P 500, you're also seeing that flat just barely to the downside. We'll round that off to 0.1% there, 3.5 points in the red. And the Nasdaq barely holding on to gains by about 0.5%, 54 points in positive territory. We're going to continue to monitor today's tape and this reaction to comments from Fed Chair Jay Powell earlier on this morning, just before we began trading. We'll be right back. Tech stocks have been getting cooked in recent weeks as the shares fall. The sector continues to shed jobs as some of the companies trim themselves to keep pace. But is the worst still yet to come for the sector? Let's bring in Paul Meeks, who's the portfolio manager at Independent Solutions Wealth Management. Paul, I want to get your perspective on the tech wreckage that's taken place here. And given the annexation to some of the Fed movements, where we could see some continued downturn for tech shares?
Yeah, unfortunately, it's been grisly, and I'd like to tell a nice tale about a quick turnaround, but I can't do that in all honesty, because I think what's happened so far, and you just showed the graphic, the tech spider, the XLK is down 29% year to date, but that has all come, or essentially has all come from just a contraction in valuation as rates rise. We haven't seen the potential second leg down, which is a reflection in this country and around the world that we have a recession, which would take down expected revenue, earnings, and cash flow. If and when that happens, then you have lower earnings multiplied to a lower PE ratio, and unfortunately, that could be your next leg down. Now, I think if we do have a next leg down, it won't be as severe as what we've had so far. But on the other hand, I think it's still too early to call the bottom in tech. If you're a long-term tech investor, that's pretty cool, but I would go in slowly and deliberately, maybe in 4 or 5 tranches over time. And I think we're also entering a new era in which you really have to focus on more valuation-sensitive tech names versus some of the heroes of yesteryear in which valuations, frankly, didn't matter.
So, Paul, look through the prism of the tech-heavy Nasdaq. Let's say, how overvalued is the Nasdaq here at current levels?
Oh, I still think that if we have a recession, which is my expectation, or at least we should plan for it and hope that we're pleasantly surprised and have a soft landing, we could drop another 15 to 20% at least on this second leg that I'm referring to.
Okay, and so this is also a sector that for some of the largest names, they are heavily exposed to advertising revenues. And typically during some of the cost restructuring that marketers and the teams of companies that are putting together their own plan to go out to consumers, when they're pulling back that spending, that directly impacts some of these largest blue chip tech stocks that we're talking about here. And so how long do you think that can continue to impact them, especially in a rising rate environment where every company is trying to figure out, all right, how is this going to hit our balance sheets?
So we know that there's a morph going on in digital advertising. And of course, if we enter a recession, total advertising spending will drop, right? We just don't have the appetite to boost these budgets like we had in the past. And so, yes, I think that Alphabet, because it has some other things going on for it, might be relatively unscathed, but they'll still be damaged. In the meantime, Facebook, even though the stock is historically cheap, I mean, it's ungodly cheap, you still have a situation where I don't know what their long-term business model is. And so until that is resolved and until we have lower estimates to reflect a U.S. recession, I'd probably still stay away.
Paul, the average investor out there, they have only known some of these big cap tech stocks. You just mentioned Facebook. That's one of them, to only go up. And now they're at home and they've seen their trading portfolios just eviscerated here, down 40, 50%. What's the action plan? What should they be doing right now?
Yeah. So what I would do is I do think that you should have a cash hoard. I think if you go into the sector at all, please, please, please be long-term focused. And then say you want to invest it $1,000, maybe you go in 5 tranches of $200 each, right? Because I'm not going to be able to pinpoint the recession. But when we do see on Wall Street, and it'll be pretty clear, wholesale estimate revisions lower for sales and EPS for all these marquee companies that you're referring to, then I can at least say if we have a formal recession or not, that has been recorded in stock prices, reflected in stock prices, and then, yeah, it might be time to become a better buyer.
Paul, we were talking about the possibility that Europe may already be in a recession. And so for some of these companies that also are reliant on revenue coming in globally and trying to figure out exactly where that's already potentially impacting them in current quarter and future quarters as well, you kind of round out the broader global recessionary risks there. How much more should we also be looking for these companies to come out with guidance that also factors in the global scenario?
Excellent question, because of course the typical tech company is even more globally focused than the average U.S. Domiciled company. And of course, not only the factors that you just mentioned, but also currency risk, right? We've seen some marquee names, such as Microsoft, talk about the beating that they're taking just based on the currency translation. I think the proof in the pudding will what happens in the next quarter's conference calls, right? So this quarter is going to end June 30th for most companies. They'll start to report their earnings the second or third week of July. That'll bleed into August. And at that point, they should have some comeuppance. I hope that they are savvy enough to properly reflect a recession, not just here, but abroad, lower those numbers. And then when we get those numbers low enough, then I could do some valuation work and say, hey, is it time to buy?
Well put. Paul Meeks, portfolio manager at Independent Solutions Wealth Management. Good to see you. Have a great weekend. Straight ahead, is it time to place a bet on gaming stocks ahead of some key sporting events? More on this next. Gambling stocks are trying to rebound today with shares of DraftKings slightly in the green. Caesars somewhat holding up there after bruising sell-offs for both names yesterday. With the NBA Finals coming to a dramatic close last night, betting companies are eyeing the Stanley Cup Finals and upcoming World Cup as potential opportunities. Joining us to discuss expectations for the gaming space is Macquarie analyst Chad Bynum. Chad, always great to get some time with you. So what is that opportunity and how might these big events shape future earnings for them?
Thanks for having me on, Brian. So what we've seen during the second quarter, which is seasonally one of the lowest quarters of the year, is some outperformance. That's come on the revenue side with more what we call single game parlays. So if you watch any of the games during NBA Finals or the NHL, it's more about engaging that customer into looking at player statistics, kind of prop bets versus just kind of the pre-match. And that's been really good for customer acquisition and customer engagement. Secondly, the promotions that are being given out to players are coming down from companies like DraftKings, Caesars, MGM. And I think that'll help the profits, which were extremely negative in the first quarter and in 2021. And then looking forward, I think the churn rates have been pretty low. Again, the engagement, the retention, the tech that we're seeing out there has been pretty good. And there haven't been any new companies to come in the space in the past couple of months. So we really like the stocks at these levels. I know everything was down about 20% in the last week, but everything is according to plan. That's what we're hearing from these companies.
If there are less promos and dollars that are given out as a form of kind of marketing or customer acquisition costs, is that something that can be expected, that they can carry on when they try to get and take advantage of new licensing that comes online in more states?
Yeah, it's a great question. The golden cohort, as they call it, is very important from a lifetime value standpoint. Generally, you look to break even in about a 2 to 3 year period with a customer. Now, right now in the United States, once Maryland and Ohio, which have passed legislation but haven't launched, once those states go live, 46% of Americans will be able to wager on sports betting. And that doesn't include any of the big, or 3 out of the big 4 states, Texas, Florida, and California, which could all legalize in the next couple of years. So I think from an advertising standpoint, companies like DraftKings have the scale where they can start advertising nationally versus locally. But then from a retention standpoint, generally the rule of thumb is that you still have to give away roughly 20% to that player to keep them engaged and staying loyal. And I think that'll start to come down as we get into the NFL season in the 3rd and 4th quarter.
Chad, I hear what you're saying on these catalysts. Certainly can appreciate them. But on the other side of the coin, we could be nearing a recession. How would these stocks fare during a recession, and how do you think the companies will fare?
Very good question. Obviously, given that this is a highly consumer discretionary sector, during the last downturn, land-based gaming in the United States fell peak to trough about 8%. So it was very resilient. What we saw in international markets like the UK, Australia, Italy, it was very similar in terms of how it held on during the recession. We don't have that data in the US just because, obviously sports betting wasn't live during the global financial crisis. What we're seeing right now on the land-based side is the back half of May and maybe the first couple of weeks of June, visitation held up, but spend per visit, particularly for that lower end customer, did start to come in a little bit, down between 5 and 10%. The companies believe that the industry will hold up pretty well. Obviously, you'll get growth from some of the new states, but that's certainly something that we're looking at. The average player in a database on a sports betting side loses a little under $1,000 a year. So that certainly is a number that we're going to be looking at as gas prices continue to rise and inflation sets in here.
Well, if we are seeing some weakening activity, Chad, do the gaming platforms have to bring back those promotions that they have started to now take away?
I think if the engagement and the retention tools are working, you don't have to. What we saw in New York, which was probably the most heavily promoted state, early giveaways between $1,000 and $3,000 to acquire that customer. You still have to do odds boost and reload bonuses to keep that player engaged. But it's really some of the tools that they have in the app right now, the single game parlays, sharing your bet slip, betting or fading your friend's bets. So more of that social environment. But we don't think there will be big promos. As we look into the NFL season, some of the early states, again, like the Maryland, Ohio, maybe New York again, because that'll be the first full NFL season, you'll start to see that come back. But states that have been in the market for 1 to 3 years, we don't expect to see big promos.
What do you anticipate on the handle for each of these platforms as we head towards and have seen some flashing signs, warning signs of a recession?
Just in terms of total wagering?
Sure.
Yeah, so the 4th quarter was pretty consistent, about $7 to $8 billion per month in the U.S. for handle. That came back a little bit down from those levels in February, March, and April, just because of the seasonality of the business. But we're starting to get to that point where the U.S. can drive roughly $10 billion per handle, aggregating all the states together. And I think the big key thing here, right now you only have about 5% of U.S. citizens engaged in the product. Getting female customers, getting casual bettors, that's what these companies are really pushing for with some of these fun, more social type of single game parlays. I think that's where you'll see engagement go from 5 to maybe 7, 8, 9, 10%. That's what we've seen in countries like the UK, where in a Premier League soccer game, you have all types of people focused on the game, betting on the game, not just kind of the diehard gamblers.
Yeah, I am a casual. I fall into that category. However, I did reload ahead of the U.S. Open golf tournament this weekend. Chad Bainon, who is the Macquarie analyst, joining us here today. Chad, we appreciate the time as always.
Thank you.
Thanks. Guys, coming up, the crypto crash showing no signs of slowing down. The latest as Bitcoin gets closer to falling below 20,000. Stay tuned. Cryptocurrencies have been slammed this week, with Bitcoin nearing that $20,000 level. So is this the bottom or just the beginning of the crypto winter? Future Perfect Ventures founder and CEO Jalak Jobanputra joins us here today. Jalak, great to have you here with us. All right, so are we in the throes of a crypto winter? Where are we at?
Well, it's good to be here again. I would safely say that we are in the throes of a crypto winter. I mean, we just saw the chart on Bitcoin. Bitcoin was already being hit by the larger risk-off macro environment that we've seen in the markets. And then within crypto over the last month, we've seen a number of companies that are more involved in the decentralized finance, the algorithmic stablecoin sector, come under pressure with I would say, due to risk management practices that were questionable. And that's just created more and more pressure on Bitcoin as well as other cryptocurrencies.
So, Jalak, how cold will this crypto winter get? Are we talking Bitcoin 10,000 as investors lose more confidence?
Well, what's been interesting is that we've seen Bitcoin hold at that 20,000 mark, and certainly it's come down. But if you see that last bit of your chart, it is kind of holding stable there. So. I can't say that it's not going to go below that, but we're certainly seeing that to be a support mark. Ethereum has been more hit by some of these DeFi protocols and these DeFi funds almost nearing liquidation, and so Bitcoin has still been holding up relatively speaking. That's not to say, it's down over 70%. So we certainly have seen a big drop there. But as we get back to, figuring out what happened with Celsius, with Three Arrows Capital, and some of these other DeFi funds and protocols, a lot of them are talking to, Citibank and figuring out some restructuring. I think there's still a lot of uncertainty there. And once we see more clarity there, hopefully we'll start to see some recovery in at least the cryptos that are solid in terms of their fundamentals.
How low could Bitcoin go, though, realistically?
Look, we saw it go down to 3,000 in March 2020 or near there. I don't think we'll see those levels again, frankly, because we've seen a lot of institutional money come into the market. Lots of dollars have entered since that point. Think if we take a step back, the run up in Bitcoin and the reason a lot of institutions are investing in Bitcoin is as an inflation hedge. We still have that macro environment. I just think recently Bitcoin's been hit by some of the other, cryptos and being kind of lumped into some of the risk that's been associated with some of these other cryptos. So I don't see it going down to that level. I see good support where we are at 20K. Of course, if we see more contagion within the crypto markets and more funds start to fail, that could change. But I still think of it as, a blue chip or the most blue chip crypto that is not as exposed to, some of these questionable risk management practices of some of these DeFi protocols.
If someone has built a portfolio, Jalak, around cryptocurrencies and they're down 70 or 80%, what should they be doing right now?
And I've always said that, this is an emerging early asset class. You should never put in more than you're willing to risk. And I stand by that. I think you have to look at your overall portfolio. If you need liquidity, I would say then you need to go find where that liquidity is. We have been holding on to our Bitcoin specifically because we do believe in it. And what we found over the years, and Future Perfect has been involved in the space. We're early stage investors, but we do have some exposure to liquid cryptos. We have held on, and we did have solid entry points. But when we've seen these crypto winters, we have seen recovery, especially amongst these blue chip cryptos.
In terms of the headcount, this crypto winter, it has taken a toll on companies like BlockFi, companies like Coinbase. You were tweeting about this week as well with some of the layoffs that had come forth from these companies in crypto. Robinhood had actually already done some of their layoffs prior to this most recent leg lower. Do you expect more of the headcount reductions to take place as a result of this leg lower, this most recent move lower and downturn in crypto prices over the past 2 weeks?
Yes, and undoubtedly, and we're seeing this in the broader tech sector too. The valuations had gone very high and ahead of themselves because of what we were seeing in the public markets, and the some of the private valuations were even higher than some of the public markets. So, those had to stabilize, and along with those higher valuations, more money coming into these companies. The hiring was really taking off ahead of its growth and future growth. So, something that Brian Armstrong from Coinbase said this week, that they hired, it was a mistake to hire as much as they did ahead of the growth. these companies often, saw these spurts of growth in crypto and were taken aback by them and didn't have the personnel to manage some of that growth. So I think this time around, they overhired, and they're seeing the repercussions of that. And we don't know how long the crypto winter will last this time around. So I think they're just being conservative. And obviously, Coinbase is a public company and has more scrutiny because it is. But the rest of the sector is certainly taking note of that and restructuring accordingly.
Future Perfect Ventures founder and CEO Jalak Jobanputra, always good to see you. Have a good weekend.
Thank you. You too. Take care.
Coming up, recession-weary shoppers have no fear. Amazon Prime Day is here. More on this next. It's that time of year again, folks. Amazon's Prime Day is back again and kicking off next month. For more on what to expect for this year's two-day savings event is Yahoo Finance tech editor Dan Halley. Dan.
That's right. We're expecting to see Prime Day kick off on the 12th and 13th this year. That means we're going to be getting big deals for the summer season. And that usually means that we'll see a lot of discounts on Amazon's own goods. Primarily, it's Amazon Basics brands, as well as the kind of tech that it has to offer, whether that's a Kindle or an Alexa, things along those lines. I think those are going to be products that everybody should be looking at in particular. But there's also deals that we'll see for, basic products that you would get on Black Friday or Cyber Monday. This might be, honestly, one of the best deal days outside of those 2 days. For things like video games, laptops, anything that you really could think of. Don't forget about home goods as well. In the first couple of Prime days, it was basically like toothpaste and toilet paper. They still have those on sale. And hey, with inflation the way it is, I'm not going to be, sneezing at any kind of deals that I can get on basic home goods. So, sneezing, I'll get tissues for those, obviously. But, I think it's going to be another big year for Amazon. Every Prime Day seems to do incredibly well and does better each time. Remember, you got to be a Prime member to get those deals. You can sign up for a 1-month trial of Prime, or you can sign up for the yearly trial of subscription of Prime as well.
Dan, also got to kind of look at the year in review here of the new head over at Amazon, Andy Jassy, who has been in the job for almost a full year. What, 2 weeks, 3 weeks out from now will be a full year. So what's kind of the review thus far?
Yeah, I mean, look, it's still TBD almost, because the way that this kind of unfolded for Jassy, really, he was kind of doomed from the start for this year, at least, right? If you look at some of the numbers, they had to expand their workforce dramatically. The stock is down 37% year to date. That's because they had hit a $6 billion headwind in Q1. They're expecting a $4 billion headwind in Q2. That's supply chain issues. That's the war in Ukraine. That's inflation. Obviously, they're talking about they added some fees for the rising gas prices. When we got to just look at how much they expanded over the past 2 years. In Q1 2020, for instance, they had net sales of $75 billion. In 2021, that exploded to $109 billion. And then obviously, we're going into 2022 right now. We're expected to see increased sales, but the cost of doing business has risen. They expanded their workforce by at least half, about double the size. For that includes fulfillment centers in 24 months. Absolutely wild numbers there. And so, in Q1 alone, they had seen a loss per share of $7.56. That really hammered the stock big time. And so, year to date, as I said, it's down 37%. But you got to wonder how they're going to try to pull this back. There's been talk, obviously, of hiring slowdowns. That's the main thing, because they have too many workers. There's also talk of them trying to sublet some of their warehouses, because that expansion was to cover the pandemic era. And now that people are going back into brick and mortar stores, they're not buying online as much because they just simply don't have to. And look, after 2 years being stuck inside, I don't have a problem walking to the mall, going through shops. I'd rather do that almost at times than shop on Amazon, though I still do use Amazon frequently. And I think a lot of people are trying to find that balance now. Amazon's got to find that balance when it comes to the expenses that it has.
All right, Yahoo Finance's own Tech DH, Dan Howley, stepping in at bat. All right, guys, that's going to do it for us this hour. However, we've got much more coverage here as the markets have entered mixed territory on the comments of Jay Powell. We've got much more at the top of the 11 a.m. hour. Welcome back to Yahoo Finance Live. I'm Brad Smith alongside Brian Sazi. We've got a lot to dive into beyond just that song that you heard, plus more that are on Brian Sazi's Friday playlist here. Let's start with a look at the markets here because things have taken a leg lower and acceleratingly so for the Dow and the S&P 500. Both of those in the red right now. The Dow down 194 points, about 0.7% there, and then the S&P 500, you're seeing that in negative territory to the tune of about 20 points or 0.5%. The Nasdaq holding on to some gains as of right now.
Look, Brad, this is the type of action we're going to see for folks who have not traded through rate hike cycles from the Fed. This is what we're going to get. Head fakes usually at the open, and then you get some commentary, as we did from Jerome Powell, that they're acutely focused on inflation. You see the markets turn lower.
That's right. We're going to keep a close eye on what has been a rough week for investors, to say the least, for sure.
Indeed it has. Let's start there. It has been a rough week for investors, to say the very least. The Nasdaq has now lost a third of its value after peaking back in November. The S&P 500 could notch its worst week since March 2020. Individual stock performance has been even more jarring. Let's look at some big names. Coinbase down 13% on the week. Robinhood down 22%. And then I would argue the benchmark indicator here, Apple down 5% over the past week. And Brad, the sell-off is starting to, I would say, accelerate, but also remind a lot of folks out there, this is the market action you should expect ahead of rate hikes from the Fed.
Yeah, there is a report to Congress that the Fed and Fed Chair Jerome Powell actually put some language within there. Unconditional is the word that the markets are latching onto, an unconditional approach to really combating inflation here. And that certainly has triggered the move that we've seen on the day here. And particularly, it raises a lot of the questions that came up on the conference call, or came up on the press conference, rather, after the Fed decision that was so heavily awaited and even leaked ahead of time on the basis point rate hike as well, on the 75 basis points that we saw come through on Wednesday at the conclusion of their two-day meeting. But even more so, this question of recession, how deep it could be, when it could take place or show up in the data, because people are already, quite frankly, feeling it right now.
Yeah, and you have to wonder, what is that next data point that could potentially take this market lower? Is it the next jobs report? Is it the next read on consumer spending? We spent the past over 2 hours talking to various economists and market minds, and just listening to their tone, you don't get the sense that any of this is priced in the market. And you look at the valuation on the S&P 500, a little over 16 times forward earnings. I get it that it's down from about 20 times or 21 times at this point last year, but still not at that screaming buy level yet.
Yeah, Beth Ann Bovino saying that it might not be as significant as markets fear, and that on the recession front. And then even yesterday, going back to Veronica Willis, who we spoke to from Wells Fargo, she said that we're expecting a mild and short recession. The bigger question for the markets, though, is what type of bear market that we've already entered into will this be? Is it a small bear, a little baby bear? Is it a grizzly bear type of equation? And what does that mean for the rotation for a lot of investors out there, too?
Well, we're about to find out. Yeah. We're only a couple weeks away from earnings season, and it's going to kick off with the big banks. And you could hear some, I would say, a 1-2 punch from these banks. And by that, I mean warnings on these conference calls from banks, but also in the card spending data that they, in fact, come out there and produce. It could be two major red flags to watch.
That's right. Well, we're going to continue to this discussion. Let's bring in our next guest. Joining us now for more on the market conversation, we've got Royce Investment Partners Co-Chief Investment Officer, Francis Gannon. And Francis, want to get your perspective on everything that we've heard from the Fed this week, including more commentary that's moving markets today.
Yeah, it's been as you said, it's been a very interesting week. And in our world, in small caps, the past 7 trading days, the Russell 2000 is off about 14%. So a lot of damage has been inflicted on the market.
Francis, where do you hide? Where can you go? Is there any place to hide?
Well, I mean, in a week where the S&P 500 entered a bear market officially, small caps entered that bear market in January of this year. And we are down about 32% from our peak last November. The average stock in the Russell 2000 through last night is off about 48%. So I think at this particular point in time, you have to start looking out about 3 years to the opportunity set that's being created in the market today. Look, bear markets are not fun, but the good thing about bear markets is they don't last. And our job is to take advantage of those particular dislocations. So I think one of the best places to hide in an environment like this is actually small caps. If you go back and look at the data. Since 1930, the small cap asset class is the only asset class that has actually outperformed inflation in every decade. And I think that's something in an environment where people are so uncertain about so many things, I think we have to kind of use history as our guide.
Well, look, three years is a long time. When you try to, if you're an average investor out there, you're down 40 or 50% on your holdings today. What do you do? If you own a portfolio of well-capitalized companies with good balance sheets, do you buy more of those stocks, or do you sell those names and just raise cash?
So in my opinion, in this particular moment in time, with so much damage being inflicted in the market already, if you can find high quality companies within the small cap asset class, this is a time to actually high grade your portfolio to add to those particular names. You've been living in a market for a period of time that is so focused on kind of those top end in terms of market cap, and that's unwinding. And we're seeing that. And then for all intents and purposes, those stocks, I think, could actually be the ATM of the market for a period of time where other markets can benefit. And small caps are clearly going to be one of those areas. What I think people are missing in some of the themes that are happening, be it reshoring or the end of kind of what we've seen, the expansion outside the United States. As companies come back to the United States, there are many small cap companies in the United States are going to be benefiting from increased manufacturing activity here in the United States. So almost think of the kind of the middle of the country as being that new kind of emerging market. And those are areas I think people should be focusing on, industrial areas that are really going to be benefiting from a lot of the reshoring that's taking place.
Francis, what's to say that small caps wouldn't be even more adversely impacted by any signs of or an indeed oncoming recession, considering their balance sheets are not typically as strong as some of the larger cap players, or at least on a revenue basis, and some of the margin basis there as well is up for discussion too?
Well, I think that's one of the great myths about small caps. And I think people miss that. Yes, 43% of the index doesn't have any earnings at the end of the first quarter of this year. So a big swath of companies don't even make any money. But I think when you actually spend time, as we do as active managers in the small cap space, what you find there are great businesses that have very solid balance sheets. And you can actually sleep at night owning these fantastic business with solid balance sheets. And I'd say we're big fans of operating leverage, not financial leverage in the companies that we own. So you can find great balance sheet companies in this particular environment. And kind of to put the correction that we've seen this bear market into, kind of to frame it a little bit, which I think is important, we're down 32% from our highs of last November. The Russell 2000, in the history of the Russell 2000, there have been 12 corrections of greater than 20%. And this is one of those, obviously. But as we were going into the COVID correction around the economy completely shutting down during COVID, the correction in the Russell 2000 was 41.8%. Today, we're in an economy that is slowing clearly, but we're not necessarily in a recession as of yet. And we're down about 32%. So I think it's a different time. Every bear market is different, but I think you have to look out to find the opportunities right now.
How do you find or unearth some of these small cap opportunities, Francis? What type of screens have you been running of late?
We tend to focus, as we have for a long time in terms of our business, on these better businesses within the small cap space. We call them, serial compounders, if you will. And so we look for companies that have very high return on invested capital. We look for companies that generate actually not only have earnings, but generate a lot of free cash flow and have the ability to return that free cash flow to shareholders. And so in looking at businesses like we have for a long period of time, we unearth these wonderful businesses and can hold on to them for 3 to 5 years. And that's kind of our goal as an active manager in this environment. We've lived in an environment where zero interest rate policies, those long duration assets have clearly benefited from valuation wise, at least from what has happened. And now I think as that pivots away from those, long duration assets, you're going to see within the small cap space, I think real businesses, and it's kind of strange that you have to say this, but real businesses with real cash flow, with real earnings, that is where the market is really going to gravitate.
Okay, so which sector within small caps particularly are you focusing on there?
Yeah, sure. Mentioned a couple here. One is industrials. I think industrials is a wonderful place to find opportunities over the next several years. Today, I would focus on information technology. And when I talk about information technology, I don't mean the sexy part of information technology. Focus on the kind of the very simple parts of tech that in our world are really important from a B2B standpoint. It means many of these products are built into other products that the world needs. And in that respect, you see constant cash flow and revenue and demand, which I think is really interesting. Other area of the market that we find interesting in this particular moment in time would be financials. Some of the financial markets obviously have gotten hit quite hard, but financials is such a big area. It doesn't necessarily have to be the banks. It can be insurance companies, and there's an interesting insurance cycle taking place today. So I think there is opportunity if you have the ability to do your work in the area right now for the next several years. And when we look at it from a valuation perspective, EV to EBIT, which is kind of our favorite way of looking at it, we're selling at a significant discount to what the Russell 2000, the market is selling at a significant discount to what it's been now over the past several years.
Royce Investment Partners Co-Chief Investment Officer Francis Gannon, good to see you. Have a good weekend. Coming up, we have a market debut this week, folks. Consumer products company Grove is going public. We're back with the CEO next. Grove getting into the groove of the markets. The consumer packaged goods company, which owns brands including Miss Myers, Burt's Bees, and Tom's Toothpaste, made its public debut today through a SPAC merger backed by Sir Richard Branson's Virgin Group. Here to talk about the company's debut, Stu Landesberg, Grove Collaborative co-founder and CEO. Good to see you. Good to see you out there on the market, Stu. Look, it's a challenging time for the markets, for the economy. How close did you get to just not coming public?
So for us, our mission is to change our category, the home and personal care category, to be a positive force for human health and particularly to have a material positive impact on our category from a sustainability perspective. And that is a long-term mission. And it's also inevitable. And so we look with a long term about our public offering and particularly going public in partnership with Richard and the Virgin Group as an opportunity to cement our leadership position as the brand that can take our category in this, our category, this $180 billion category in the US, and transform it to be better for people and especially planet.
Does this mean we're going to see Grove products in some of the Virgin hotels?
I sure hope so. I'll say we're working on it.
Okay, a follow-up to that, of course, we've seen other de-SPACs, as Brian was mentioning a moment ago, cite uncertain market conditions. And so with regard to today and the liquidity moment for the company, What does this mean in terms of advancing and investing into the operations of the business?
So we look at the long-term goal as how do we bring our products, which are the most sustainable, the most efficacious, available at a really attractive price point, and candidly are beautiful to as many customers as possible. So looking forward, we've built a $300 million plus business in the direct-to-consumer channel, but we're seeing 100+% growth in retail. We launched in Target last year. That's been extraordinarily successful, and we expect to see explosive growth as we add points of distribution over the coming years and bring the Grove Co. brand of products especially to millions more consumers every single year who are making better choices for their homes and for the planet.
Stu, you mentioned Target as a key customer. They were out recently warning about the state of their business, high levels of inventory throughout the stores. Have they taken a more cautious approach to inventory?
I can't speak to Target's overall approach, but what I can say is that we've seen a terrific commitment from Target to build a more sustainable assortment to help their guests make choices that are better for the environment without compromise, which is why I think our platform of sustainability, efficacy, and affordability is so important. And we've been lucky to be able to expand our points of distribution with them over 100% year over year. And we're doing that because our product performs with every customer, and it performs in a great economy, and we've seen it continue to perform well, even in a more challenging economy today.
Customers in this economy as well, though, have been prone to trade down on some other products. And so to what extent are you monitoring the rate at which customers are trading down into, and especially in the categories that you operate within?
So we always look closely at the data. And of course, we operate a direct-to-consumer platform with millions of customers. And so we see an extraordinarily fine grain of data. And what we're seeing right now is that our brand has real resonance and real strength with our consumers because our brand is so strong, because our product innovation, like our 1 ounce concentrate, our cleaning products, we sell a 1 ounce concentrate, which you can put in a reusable glass vessel, totally different from everything else in the market. And so we've been lucky to see a really resilient consumer and a really strong brand that's had really great loyalty. And so I know overall the category is struggling, but we're lucky to play in a space where brand loyalty is extraordinarily strong. And we offer a product, hand, dish, bath tissue, good economy or bad, people are still doing their dishes. So we're really lucky to have a strong brand in a consumer staples category in a market like this one.
Stu, I'm on the investor relations page on your site, and the last presentation that I see is looking for about $514 million in sales for next year. Should we slip into recession? Can you still hit that?
So if you look at our projections over the long term, and I think if you look at our most recent guidance, we've done a good job of this. The market right now is asking companies to get profitable quickly, but our long-term goal is to be a double-digit above industry average grower, which is consistent with the trends in natural and e-commerce in our space over the last several years. And I think what you can expect from us is to drive gross margin really hard, drive EBITDA margin really hard, and get the business more quickly than we previously thought possible to a place where we're generating positive free cash flow and are growing at double digits above industry year after year after year.
Timeline, when do you expect to achieve profitability?
We've said we'll be profitable in 2024, and I feel like we have a lot of the levers in our control to make that happen. I feel more optimistic about that path to profitability today, even given the market environment, than I ever have in the past. And again, that goes back to the loyal customer base, the strong brand in extremely durable categories, and the innovation I know we have rolling down the pipe, which I hope creates upside for us.
This year, Stu, how much of an inflation headwind are you seeing in your business?
So we've always had really good pricing power. We haven't said anything publicly about whether or not we'll take prices, but historically we've had success when we do. And on the supply chain side, because we're so committed to quality, the vast majority of our supply chain is in the US. So we've seen some cost inflation, but we've been able to avoid passing much on to the consumer at all, and we've been able to maintain strong margins. And we expect both of those things to continue to be true. So we've fared, I think, certainly some impact, but we've fared quite well on a relative basis in terms of supply chain impact.
Stu Landsberg, who is the Grove Collaborative co-founder and CEO. Congratulations to you and the company on this milestone occasion. We'll have to check in the future. Thanks.
Looking forward to it. Thanks again.
You got it. All right, guys, everyone, let's take a quick look at the markets here as we are just a little bit over 90 minutes into trade, actually closer to 110 minutes into trade. Quick math there works out. All right, this market check is sponsored by Flex Shares. Dow Jones Industrial Average, you're seeing that back in the green. Don't call it a comeback, because it's not fully.
I won't.
Fully a comeback. The Dow Jones Industrial Average right now is up, though, by about 0.1%, 39 points in the green. S&P 500, you're seeing that up 11 points there, 0.3% in positive territory. And the tech-heavy Nasdaq, you're seeing that sitting higher, triple-digit gains as of right now, 131 points higher on the day, 1.2%. Coming up, everyone, Inflation Nation. As prices rise, some states are taking it a lot worse than others, where consumers are losing the most confidence ahead. Welcome back to Yahoo Finance Live, everyone. Inflation crushing consumer confidence nationwide. A recent survey by Morning Consult. It shows which states are losing consumer confidence in the midst of rising costs. Yahoo Finance's Danny Romero joins us with the latest breakdown. Danny?
Yeah, Brad, Americans are in search of relief as consumer prices really hit that 40-year record high. We just saw last week that the U.S. consumer confidence tumbled to a fresh 11-year low, reflecting really the concerns around inflation. Now, by a state-by-state level, according to the Morning Consult's index, consumer confidence fell in 48 of the 50 states, the most since August of 2021, and the average ICS deterioration rate was 5.1%, the sharpest decline since April of 2020, right around when the economy shut down. Now, on the other hand, now let's look at the states. Alaska, North Dakota, and Montana saw the biggest drop in consumer confidence. Now, on the other hand, Nevada and New Mexico really saw the improvement when it came in the month of May, with their ICS numbers rising to 1.8% and 0.4%. And that could have been attributed to the fact that travel and tourism sector, they're really recovering from the pandemic. Now, according to this survey by Morning Consult, they saw the sharpest really decline in July of 2020 when it came to consumer confidence. And that was all due to the coronavirus cases really starting to surge up once again. And then from there, we were hit by supply chain issues that really caused an increase in prices. And then this year, we were hit by the variant at the beginning of the year. And then in May, the big focus around consumer confidence still remains around inflation. So that's really when, we started to see the consumer confidence start to tumble. Guys?
And Danny, what about the global outlook?
Yeah, the U.S. consumer confidence, is falling really further behind from Mexico and Brazil. Now, one advantage that Mexico is really resilient comparison to us is that due to their gas and fuel subsidies, which is really helping consumers from rising energy costs. But however, if the U.S. falls into a recession, it will be difficult for Mexico to avoid it due to the fact to the close trade and economic ties between the two countries. Guys?
Danny Romero, thanks so much. Coming up, Yahoo Finance senior columnist Rick Newman will join with his latest Bidenomics hot take. Don't go anywhere. President Biden has had a lot to say about the state of the U.S. economy, but one thing he has been relatively quiet on, stocks. Yahoo Finance senior columnist Rick Newman joins us for This Week in Bidenomics. And Rick, no tweets from the president on stocks.
No tweets, no nothing. He really has nothing to say about the stock market. He's been talking a lot about the economy. He clearly is trying to send a message to voters. He knows inflation is too high. He knows gas prices are too high. He feels everybody's pain. But he has not expressed really any sympathy at all for stock market investors. And if you go back to his, look at what he said about the stock market during his entire presidency, about 18 months so far. He really has never said anything about the stock market. He mentioned it one time last September, and he said, you'll notice I've never said a word about the stock market. Then he said a word about the stock market. He pointed out it was up 17% since he had taken office. Of course, it has turned around lately with both the S&P and the Nasdaq in a bear market. So the White House has been getting questions about this. Is President Biden aware of what's happening in the stock market? What does he think? And basically, the spokespeople have said he's aware of what's happening in the stock market, but he doesn't consider the stock market to represent the overall economy. And I found one clue to his thinking in this interview he gave to the Associated Press yesterday. He talked about the Trump administration, and he said one of his frustrations about the Trump administration was that, and this is a quote, everything was constructed and built and arranged in order for the top 1% to 3% of the population to do very well. Everything else seemed to be an afterthought. So that suggests Biden doesn't want to express a lot of sympathy for investors losing money in the stock market because he considers them to be wealthy people, and he wants to focus more on lower income and middle class people.
I guess the natural thought would be we have to consider and take into account here the number of new investors that have entered into the stock markets over the past year and change, whether that be because of the meme stock frenzy, whether that be because of some of the stock splits, making big companies, household names, Tesla, Apple, Google even, more accessible to some of those investors, even as we're waiting for some of these new stock splits to still take effect. Should the White House have a more concerted strategy around this from this point forward?
So you're talking about speculators, I think, more than what you might call long-term investors. And you could also toss crypto investors or crypto speculators into that group. They're obviously taking a beating as well. But I think even more broadly than that, Brad, I mean, like half of Americans own stocks, and most of them are not speculating. Most of that is retirement savings. That's 401k plans. And, it starts to seem a little mysterious that Biden doesn't acknowledge that people's nest eggs, their retirement accounts, are actually losing value. A lot of people who have retirement accounts also own a home, and that asset is actually doing very well. That is appreciated by a lot. But in terms of the wealth effect, people, do look at their investment accounts and their retirement accounts, and no one likes to see, negative numbers in your retirement account. So I think that is probably contributing to this gloom and some of these terrible confidence numbers that we're hearing about. So I think it would make sense for Biden to address this at some point.
Yahoo Finance's own Rick Newman joining us now to break down everything, or joining us to break down everything Bidenomics. Rick, we appreciate the time here.
Bye, guys.
See ya. All right, guys, coming up, we've got more of a tech dive here. The latest feature that users are not that excited about here as Instagram goes full screen. Stay tuned.
More controversial news for Elon Musk. SpaceX has reportedly fired several employees who took part in a letter that was critical of both the billionaire and the space company. Yahoo Finance tech editor Dan Halley joins us with more. Dan.
That's right, Brian. This is a report from the New York Times saying that an unknown number of employees were released from SpaceX as a result of this letter that was written, basically criticizing CEO Elon Musk and his recent public behavior on Twitter in particular, as well as that report from Insider saying that there were allegations of sexual harassment related to a former flight attendant on a former SpaceX flight attendant in which Elon Musk apparently paid $250,000 to after those harassment allegations. And so they were basically trying to get the employees of SpaceX to sign on to this letter, asking leadership there to denounce Musk's behavior, or at least try to separate his behavior from SpaceX's own mission. But now those employees have been let go. And, there was obviously he spoke with members of Twitter, employees at Twitter yesterday, kind of going over everything that he plans, or most of what he plans for the company if he buys it, though he didn't say specifically that he still wants to buy it during that conversation. And so, now there's worries in Twitter, obviously, about how their activism will mesh with Elon Musk's management style and whether or not they would then face consequences for their own activism at Twitter.
Okay, so from what we're hearing in this report about SpaceX, from what we know in terms of the internal culture and the settlement that took place for racial discrimination at Tesla, for all of these question marks around how Elon Musk or the culture underneath of some of his companies is run, I think it's a fair question to ask. Is the profile himself still enough as a talent acquisition pool if enough employees are saying we disagree with how these companies are being run?
It's interesting because there are a number of people, obviously, online, Twitter specifically, who, watch what Elon Musk says with bated breath, right? They'll follow him regardless of what he says because of what he says. And there are probably a good number of talented people in those ranks, but you have to imagine that perhaps not many, it's not a majority of people who see what he says and think, yeah, he's right on everything, or, he should have this kind of free reign over Twitter, or, have free speech absolutism for Twitter, which is what he says he believes, and then kind of stifle the speech of people at his other companies in this kind of way. So, it's hard to determine whether or not it'll start impacting the business itself. The big thing that everybody looks at is Tesla and how that will be impacted by his behavior. And look, I mean, the guy sent out a tweet saying, funding secured, 420, smoked weed on a podcast. I mean, he does all these things, and Tesla's still, outside of the slump caused by the overall market and economic activity in general. The stock is still doing incredibly well. So people are buying Teslas left and right. I mean, I don't know if it'll ever impact the companies themselves or the people who would work there. I think, at this point, I don't know what kind of issue he could do or cause that would make people take a step back.
All right. Yahoo Finance's own Dan Halley will continue to track this report as well as what comes next in kind of the world of Elon Musk at this point as well. Switching gears here, we got to talk retail on the day. Retail is under pressure after seeing a steep reversal in May, with record inflation causing a pullback for consumers, in turn producing higher inventories for companies. Joining us now to discuss the outlook for retail is Bernstein senior analyst Anisha Sherman. Anisha, great to have you here with us. Help us break this down a little bit, especially given some of the retail readings that we've been tracking. What does this shape up for the current quarter that we're in and the results that are set to start rolling in over the summer as well?
Yeah, it's been a bit of a mystery this year because overall the numbers show growth. So the apparel retail sector grew high single digits in March, high single digits in April, and high single digits even in May. And the March-April data was on top of triple-digit growth last year. So at a top-down level, it looks great, right? But there is a bifurcation in there, and we're seeing the more discounted concepts being hit much harder. And we've seen the results from Target and Off-Price talking about the low-income consumer pulling back. But at the same time, if we talk to companies like Tapestry that owns the Coach brand or Lululemon that target the 100K plus affluent consumer, their demand remains robust. So we're seeing that bifurcation, and I think we're going to continue to see that in the current quarter. I think the question is, if we continue to see high inflation and if unemployment starts picking up, then does that bifurcation blend? And so do we start seeing a pullback at more middle income and slightly higher income points, at which point it starts to impact the broader sector and not just the value players?
Anisha, are there companies in your coverage universe that you think are not well prepared to withstand a recession?
Yeah, so in my coverage universe, there's some recession-resistant companies like, off-pricers I think will do well in a recession. But I think some of the discretionary brands, so, even the bigger brands like someone like a Lululemon or someone like a Nike, if there is a large-scale recession that affects the middle income and kind of across-the-board consumers, they will take a little bit of a hit. But I think what we see in recessions is that big brands and big retail concepts tend to consolidate share. And so I think the bigger players are more defensive. The bigger risks to me are the small and medium sized, both in retail and in terms of brands, because they will lose disproportionate amounts of share and they don't have the operating leverage or the cash balance to get through negative sales numbers without having to close stores and make other more drastic cuts.
Has the pricing power that these companies exhibited within their most recent growth phase, has that evaporated?
So far, not at all. So on the higher end, all of the brands and retailers almost are taking price up. So we're seeing that from luxury downward into premium, downward into mainstream. Everybody is talking about price raises. They're doing it under the umbrella of kind of the whole industry taking price. And with inflation going up, that's a good way to pass on the cost to the consumer without the consumer pushing back. Even at the low end, we're seeing some retailers able to take price. TJX is a good example of this, where they've been able to take price on their more higher end assortment that targets the more affluent consumer. So if that affluent consumer starts looking a little less healthy financially in the next few months, then that outlook will change completely. But so far, pricing power has held up.
How do you explain the strength? You mentioned Tapestry. Is that a function of folks traveling again and going back to the office?
Yes, absolutely. So, this trade-off that we hear about between things and experiences, that does not apply to apparel and accessories. Apparel and accessories is driven by experiences and occasions. If you're going to a wedding, if you're going on a trip, you're going to buy an outfit and shoes and a handbag to go with that. So the huge surge in travel that we're seeing and in occasions and even going back to work has led to a surge in buying, which helps Tapestry. They sell handbags. It also helps the shoe and apparel brands.
Nike's an international company. Adidas is an international company. Lululemon, international company. How much is an impending recession, not just in the U.S., but even internationally as well? How much is that a headwind risk that they need to account for right now?
That's a great question. I think actually the risks are going to be staggered. So at the moment, all of the companies you named are suffering huge declines in China, right? Because that market is locked down. But as we're going to see China coming back, as we're going to see that spend surging, some pent-up demand unleashing towards the back half of the year, we may see more pressure in North America. So I think that being international, particularly having exposure to China and Asia, is going to be defensive over the next year because the impacts are going to be staggered between North America and East Asia.
Anisha Sherman, Bernstein Senior Analyst, always good to see you. Have a great weekend.
Thank you.
Demand is on the rise for in-person dining despite rising inflation, with a new Yelp report showing a reversal for the restaurant industry. Yahoo Finance's Alexandra Canal joins us now with the details. Alex.
Hi, guys. Yeah, so Yelp is out with their State of the Restaurant Industry report, and there's some interesting little tidbits in there. According to the report, more than 13 million diners were seated via Yelp during Q1 2022. That's a rise of 48% compared to the year-ago quarter. Now, reviews did mention obvious staffing shortages, longer wait times, along with those higher menu prices, which, by the way, jumped 7.4% during the month of May, according to the latest CPI print. But despite despite all of that, consumers, although they're aware of inflation, they're actually wanting to spend money on more higher-end, upscale experiences. So I guess they figured if prices are up everywhere, we might as well go big or go home. Why not? So we're seeing that on the rise, in addition to takeout on the rise too. Although that did dip slightly on a year-over-year basis, we are still seeing numbers up compared to 2020 and 2019. So those numbers, by the way, should be up 107% increase and 144% increase. So that shows that that could possibly be another pandemic-era trend that will continue.
Yelp also noticed an uptick in experience dining here. So break this down for us. Like, what exact experiences are consumers gravitating to in this climate?
The fun stuff, Brad.
Okay,
So
all right,
think
cool.
conveyor sushi, think dinner theater. Yes, dinner theater, supper clubs, internet cafes.
You just stand at the end of the bell.
Yes.
Just open your
You know,
mouth.
I've been to
Cartoon
dinners.
style.
I have been to dinners though where you sing and you dance, and I think that's fun. I think it relates to the fact that people were stuck inside for 2 years during the pandemic. Yes, there's inflation, but they want to get out there. They want to have fun. They want to experience different types of things, different types of dining experiences. You're seeing there all the different options that are available to people. So I think this just speaks to the fact people want to spend more on experiences, and there you have it.
You would appreciate this. I paid $24 for a Chipotle bowl this week, having it delivered. If I'm going to pay this, I'm going back to
Because you had it delivered.
I want to get this experience. I want to smell burritos. I want to smell beans.
Exactly, and that's why I also think takeout is actually going to be more popular, because for me, anecdotally, I'm not going to spend $10 to $20 more to get it delivered. I'd rather drive or walk and just pick it up at the window, because the fees are insane, and it's only compounded by inflation too.
How do you think this is impacting? You know, we've seen menu prices go up through the roof, but I wonder how the likes of a Darden are starting to feel this impact here as well.
Yeah, and they report earnings next week, so I'm sure that we're going to get a little bit of an update on that. I think it is reassuring that in-person dining is returning, and also there's a ton of demand for both outdoor and indoor, which is interesting. I guess people are more comfortable with the pandemic at this point. So I do wonder how that will impact Darden's bottom line.
It just costs you $20 to actually drive to an Olive Garden.
Right.
10 miles away, $6 a gallon. Yeah.
Right. By the time you've already factored in the delivery costs.
It's crazy. It's crazy out there right now.
Two things really quickly on this conversation, though. On what head count are they going to see this kind of interest continue to tick higher? And then additionally, I mean, operationally, they are looking at different days that they're even, like one of my favorite spots in Bushwick, I'll shout them out, Forest Point. I'm there all the time. And they have refined the number of hours and days that they are actually operating. And so many restaurants have already done this, in addition to adding on the delivery options and so forth. So what does the realistic equation look like for them? What type of staffing are they going to need necessary in order to give the people the experience that they want when they're coming out of kind of the work from home, everything from home hibernation?
Staffing is certainly probably the biggest issue that all restaurants are facing. So they're having to get a little bit creative to bring in different types of revenue. Ghost kitchens actually becoming very popular. Yelp added a feature in September that you could label your business as virtual. Since they did that, 3,000 businesses have said that they have ghost kitchen operations. So that has helped alleviate some of that staffing pressure, but that is certainly an issue that's going to have to be addressed. You need to potentially do benefits, higher pay. How do you get people to work when no one really seems to want these jobs right now? And that's going to continue to be a challenge for them.
There better be people at my local Wendy's, because I'm ordering Wendy's today. I just decided right now.
Oh, a Frosty?
I'm
He's a Baconator fan.
I'm getting
He's
free chicken
definitely.
sandwiches.
And a Frosty. Add a Frosty to my list.
All right. Stick around, Allie, because we've got much more. Guys, coming up, Watch the Throne. Jon Snow is coming back, but do fans want it? The Game of Thrones spin-off news that has the internet in a frenzy. That's up next. Welcome back to Yahoo Finance Live, everyone. We want to turn now to the stories that we cut for time here. 3 headlines influencing markets in one way or the other, all delivered in 3 minutes. Starting with Allie, what are you watching?
So Kit Harington, a.k.a. Jon Snow, he is reprising his role for a new Game of Thrones sequel. Now, this sequel is going to take place immediately after the events of Game of Thrones. So many people thought this was going to be an ironclad ending, but I guess that's not the case. I do love when sequels bring back original characters. I think it keeps the integrity of the show. And it also means that we could potentially see some other characters pop up for Game of Thrones. I don't know if you guys are fans of this series. Okay, great.
I am a fan.
So I am going to get trolled. I'm going to get trolled for this. I watched the final season because I wanted to be a part of the water cooler conversation, but I did not watch anything.
I knew where this was going.
That's good.
Now,
that's a life hack.
I was basically bugging my roommate the whole time. You're like, okay, so I had literally a notepad, like, who's this? What's that? She goes, I'm going to kill you. I wanted to enjoy this final season, and you ruined it for me.
My word. Okay, well,
I know.
I'm a fan, and I'm not even looking forward to this.
It's a lot of effort, though.
Like, why can't we just leave some things? Like,
Yes.
just have it be done. We don't need a reboot of it. We don't need
There's
need
multiple
prequel, the
prequels in the works,
sequels.
too.
Yeah, we're on Jurassic Park 17 by this
and the
point,
last
so-
one is the worst reviewed in the franchise.
Yeah.
So I don't know.
It's a good thing. It's coming at a good time for Discovery, post merger and acquisition. Good for them.
Yes.
Jon Snow, moving markets. There we go.
As for me, energy woes mean higher gas prices, but the rising cost of diesel also leading to increased prices. And I got to give a shout out to our very own Ken Underwood. He's on the other side of the camera today, working very hard for us. You know, he reminded me of that shock when you go to the gas station, you walk up there and you see $6.50, and you realize, wow, that's my gas price right now? No, it's actually diesel prices. And that was my take or reaction last week when I would fill up my car. And diesel prices were actually $6.40. And diesel prices across the country have gone through the roof. Now at $5.72 a gallon, up 75% year over year. Now, that has major ramifications for, of course, the economy. Truck drivers, people that drive large SUVs. I've seen TikToks and people cost to fill up an average truck $150 right now. It's just amazing.
It trickles down to the consumer, too,
Absolutely,
though.
yeah.
Because when companies talk about this being factored into the price that you are paying, this is exactly what they're talking about. How much operational expenses the truckers are taking on, and thus us, in order to get that product. And for even those that are opting up to freight, they might be opting up to freight or air freight as well. And we're still going to see all those costs at the end of the day.
And truckers are the backbone of the American economy, right? Like that's how we get our Amazon packages, our groceries, our furniture. It's crazy to think about this ripple effect. And it's really going to impact these smaller truckers too, and those smaller fleets. So I think it's really devastating.
I'm really happy I do not drive a Mercedes diesel.
No, yeah, I 100% agree with you.
I know you're a Mercedes fan, though.
I am a Mercedes fan. Newfound respect for, well, of course, always a respect for truckers who navigated throughout this entire pandemic in more ways than one. My grandfather was a truck driver. They do a ton of great work out there on the roads. All right, guys. Also, we got to talk about Instagram, the IG, testing out a new layout that actually brings Compose back to the center of the navigation bar. Thank goodness. That place currently occupied by access to its TikTok competitor, Reels. Now, the changes also include a new full screen feed similar to TikTok. All right, so we're taking a look at, I think, some of the changes that are going to be taking place here. But I don't know if you guys are even on TikTok all like that, but I don't know if I'm ready for yet another change. I was
just about to say that. Can we stop updating Instagram?
Right.
I'm over it.
Done.
The layouts, it's confusing. They seem to do it and people complain.
Yeah.
What is the reason?
I just want a simpler Instagram. Maybe it's me now being a middle-aged male. Whatever it is,
It's not user-friendly.
I need something easier to use. I can't keep track of all this stuff, and I'm still trying to figure out how to make a great TikTok. Man,
I don't think I've ever made a reel. I have made 2 TikToks before. Really? And that's
I haven't made a reel either, but I'm curious.
Yeah.
Just
I
make
want
it.
to do
Just
it.
make it easier for us, not easier for you to make more money there, Meta. Please make it easier for us.
It's hard to even do a boomerang story, let alone make a reel. I'm like, where's the boomerang button? I can't figure it out. I'm over the updates and the layouts.
Oh man, we really
too much.
We really sound like geriatric millennials here.
Giving away our age.
All right,
here.
let's leave it there. Let's on that high note, let's get a quick check of the markets here on what has been a wild week for investors. Seeing the markets, you're seeing the Dow now down about 100 points. Again, this whole session was set in motion here by Fed Chief Jerome Powell saying the Fed is acutely focused on fighting inflation. You're seeing the Dow down now 112 points, the S&P 500, Nasdaq, a little more mixed action. That's it from us here on Yahoo Finance Live. We'll be back at 3 o'clock with more markets coverage. Have a great weekend.
Tech stocks are continuing to get battered amid the broader market sell-off, with tech giants like Meta, Alphabet, and Netflix all down significantly year to date. Cowen's senior analyst John Blackledge joins us now to discuss here. And we had seen some of these tech stocks moving in lockstep, particularly with what the Fed was signaling. And so now that the Fed has made their decision yesterday and kind of telegraphed what the pathway forward may look like, how do you expect tech to continue to react from here?
Yeah, I know, and thanks for having me on. We had a couple notes. It's interesting. We had a couple notes out this morning on Alphabet and Meta. We did just mid-quarter ad checks, right? With all the macro headwinds, rates and inflation, geopolitical. We're just curious. We checked with our agency that we use, our digital ad agency, to see what, where we were for Meta and Alphabet 2Q to date through May. It was interesting for Meta. Our agency saw ad spend down about 4% through May. We have for the full quarter plus 2%. So it's tracking below where we are for the full quarter. But remember last year, the iOS 14.5 changes started in 2Q21, so the comps actually get easier for Meta as we get through the quarter. So probably our numbers probably still okay. On the go forward, it's a bigger question, and the question would be about ad demand with the rising rates and all the macro headwinds, and we'll try to examine that as we get through the back half of this year and into next year. And then for Google search, our agency check was 18% growth. Through May, we're at 16% for the full quarter. So, kind of tracking relatively in line with where we are. And it's a little bit of a decel from the first quarter growth rate. So, it seemed despite everything that's going on, the numbers for the two companies seem to be the near term numbers seem to be tracking kind of where we are.
Hey, John, it's Julie here. Is there, though, when you're looking at that ad spend, is there a direct correlation between higher rates and a slowdown in ad spend? I mean, and a direct correlation through several layers, right? If higher rates are affecting, consumer spending on the margin, and then that affects these corporations, and then that affects what they're spending on ads. Do you expect to see a more severe feed through as rates continue to move up?
Yeah, there historically for advertising, there's a direct correlation with GDP growth. So to the extent that the higher rates lead to, kind of slowing GDP or declines, people are calling for a recession at some point, maybe back half of this year and the next year. And so if you look at, I think the thing that matters is what is earnings next year for these companies. Are the rising rates and the macro headwinds, are they factored into stock prices right now? If you look at, just take Alphabet in the 08-09 recession, they obviously see the demand dwindling during that time period, and they put the brakes on cost growth. In 09, their cost growth was 0%, and their earnings were kind of in line with 08 levels. And as 08 was getting into 09, you saw the cost growth slowing down and then just flat in 09. So I think, for these companies, and you also saw in 2020, when COVID hit, both Alphabet and Facebook wasn't public in the 08 recession, their cost growth really, they put the brakes on costs. So that's what we're kind of going to be looking for. And they're going to see slower demand before any of us see it, and then I think they'll act on that. And even for Meta, they're losing a lot with their metaverse investments, and you're seeing reports since they reported 1Q that kind of they're slowing hiring. So we'll have to see. But in the near term, it looks like things are kind of where we think they should be, but obviously there's interest rates and all of the headwinds are clearly going to be around for a bit, and so we'll try to do the best we can to forecast, kind of through the year and into next year.
John, how bad does it get for Netflix in a recession?
It's interesting. We did a ton of work on their potential ad business. That we published that yesterday, and I would say what's interesting is we think they're going to introduce an ad tier. Our work, and we do a lot of survey work, monthly proprietary survey work at Cowen, and our work suggested that if they introduce a new lower price ad tier, they could add up to 4 million new members in 2023. And we think they're going to introduce the ad tier sometime late this year, fourth quarter. And so 18% of people, of non-member respondents, said that they were either extremely likely or somewhat likely to sign up for a new lower priced ad tier. What does that mean? Well, it means from a revenue perspective, we get to about $900 million in incremental revenue from those members. And how, what does that look like? Well, we get to about $17 in revenue per member per month for a new ad tier, and that's broken into a $6.99 subscription fee, which is kind of around where other premium streaming platforms are. It's also 30% below Netflix's basic tier, which is its lowest price tier. And then we got to about $10 a month on the ad side. But to the question, if they offer a new ad tier, it's going to be cheaper, either for new members or if existing members want to switch. For instance, we also asked the question to existing members, would you switch to a lower price ad tier? And 41% said that they would switch. And you guys probably know that Netflix currently has 3 tiers, the basic at $9.99, the standard at $15.49, premium at $19.99. And half of the basic members and 40% of the standard and premium members said that they would switch. So if they do switch, and what's interesting about the basic members switching, the $9.99, they're paying $9.99, they would feel good. Yeah. Going to $6.99.
But John, let me ask this, because isn't it a big longer term risk for Netflix if you have people switching from higher price tiers just to these lower price tiers? Doesn't that over time bring their margins down? Does it hurt their cash flow?
No, that was the whole thing with our work yesterday. Just take the switchers, for instance, which we were curious about it. I think it's a great question. We think they're going to generate about $17 per member per month for an ad tier. the blended ARPU for the company was about $15 in US and Canada in 1Q. So net, it's going to be incremental. And we're after we did the work, we were talking about it, saying they probably should have done this sooner. So no, I think it'll be net incremental, and that was and that's what we called out yesterday. It is a positive multi-year revenue opportunity for the company.
John, always good to catch up with you, and especially right now, given what we have been seeing in technology. Stay strong, man. John Blackledge, right. Good to see you.
Thank you.
Marriott Vacations is launching a new ownership program, Abound, targeting leisure travelers as the hospitality industry looks to capitalize on the summer season and bounce back from COVID-19. Joining us now to discuss is Marriott Vacations Worldwide CEO Steve Wise. Steve, good to see you here this morning. So talk us through a little bit about this program. Why now?
Well, thanks, Brian. Appreciate it very much. If you step back from it and look at it, I mean, leisure is absolutely booming, and we're very well positioned for that because we're 100% leisure focused with some of the greatest brands in the travel and hospitality business. And as we have looked at it, and we understand that vacations are becoming less of a discretionary decision. Many people now think that they're going to take a vacation regardless of what happens in the economy. We have gone about over the last 2 years kind of repositioning our offerings going forward to try to come up with what we think is the next generation of vacation ownership. And as a result, we've launched an initiative called Vacations Next. And a big component of that is our Abound program, which we announced this morning. And what that does is it allows the members of our 3 different Marriott branded vacation clubs that heretofore have interacted independent of one another to be consolidated into one program with a single currency and the ability to be able to travel across 90 properties, et cetera. So we think with that and the relevance of vacations becoming even more important, that we're very well positioned for the future.
Steve, when you look at all the incoming data in your business, are you seeing any signs of a more cautious consumer?
At this point in time, no. We're running some of the highest occupancies we've ever seen. And I think a lot of that has to do with the fact that we have our owners that bought the product and want to use the product. They want to be on vacation. And as a result, they're out traveling as much as possible. In fact, if you look at our forward bookings for both the owners and our preview guests, they're up about 14% for the balance of this year over what they were at this time in 2019, pre-pandemic. So we're not seeing anything yet. Having said that, obviously, we'll keep our eye on it and try to react to it accordingly.
When we look at the rate environment right now, Steve, what kind of effect are we going to see on your what kind of effect are you guys going to see on your business as a result of that, even as you're seeing this high demand from customers?
Well, I assume you're talking about lending rates?
About interest rates. Interest rates,
yeah. As about 60% of our customers take our financing, and we have enjoyed the ability to lend at call it an average coupon rate of 12.5%. And up until recently, our cost of funds have been sub 2%. So it's been a very lucrative business. Obviously, as the base rates go up, the spreads will tighten a little bit. And as a result, we'll see a little bit of degradation in the spread, but it's still a very, very positive and profitable business for us. One would say, well, just raise your coupon rate accordingly, but based on the customers that we deal with, which are typically at the higher end of the spectrum, they're a little more sensitive to those high interest rates. So we have to temper whether or not we raise the rates and potentially somebody who says, well, I'll just write a check versus doing it at a slightly lower rate and taking a little less spread.
What kind of change have you seen in the customer profile, especially considering even with Abound, you look across millennials who are looking at travel as an aspiration, but what we've also seen over these past few years is a rise in the number of rentals, even for some of those kind of unique or niche experiences. So where has Marriott Vacations also kind of leaned further into where it can bring that into the portfolio?
That's a great question, Brad. The way we think about it is by putting Abound together, we have 90 world-class resorts. We have the ability to use your points currency across 8,000 Marriott branded hotels, 2,000 rental homes, a couple thousand of different kinds of experiences, whether they be culinary or arts or guided tours or everything else. We actually think this is very, very positive for folks that are looking for a variety of vacation experiences where they don't have to go outside the system to be able to take advantage of that. And that's one of the reasons why we've moved in this direction.
Steve, thanks for being here. Steve Weiss is Marriott Vacations Worldwide CEO. Thank you.
Okta is coming off a better than expected quarter despite big companies looking for new ways to cut costs with a potential recession looming. The company raised its outlook as demand remains strong. Customers looking to invest in security infrastructure. Joining us now for more on the state of the software space is Okta co-founder and CEO Todd McKinnon. Todd, good to see you as always. Look, you were one of the few software players to actually raise your outlook. What gives you the confidence in doing so in this type of volatile environment?
Well, first of all, thanks for having me on. It's great to be on Yahoo Finance once again, Brian. Our success is driven by, in the big picture, three big trends. And these trends are long-term and very enduring. The one is companies want to do more with cloud computing. You talk about managing through a choppy investor market and potentially a choppy economy. Companies want to do more with less, and that's what the cloud is all about. The cloud is about using this modern technology to make your workforce more productive and lower your costs and increase your revenue. That's one major trend that's driving us. More cloud, you need more identity to manage it, and we sell identity, so that's good for us. The second major trend is companies want to get closer to their customers. They want to build better websites and mobile apps and have that great customer experience. You want to be able to go online if you're going to take a vacation and check your reward points online. You want to be able to interact with all of the products you use as a consumer online, and companies want to invest to make that customer experience great. And identity is at the center of that. And finally, they want to do it all securely. It's no good if it's easy to use and convenient if it's not secure. Companies don't want to be hacked. They want to be secure. They want to keep their customer information secure. And we help them do all of that. And that's why we're confident raising our outlook and going into the remainder of this year and the years ahead.
Well, all that stuff sounds fantastic, but all of it takes money. And right now, with the headwinds that we are hearing about, with the sentiment certainly that we're hearing about from a lot of CEOs, maybe they're going to be less willing to open their wallet, to open up their budget, to write you guys a check. Are you seeing any signs of that kind of pullback, in your customers?
We're not seeing that. Demand remains robust and our pipeline is strong. I think the one thing that gives us, we're obviously like everyone else, we're being reactive where it makes sense and doing what we need to do to navigate the choppy market and potentially the economy changing direction. But the one thing that gives us confidence is it's not just us speculating that these demand trends are robust. If you look at something like the Gartner CIO survey, CIOs are surveyed and they say over 2/3 of them say they have to continue to invest in security because it is a pillar of what they're trying to do. And also a lot of the products we sell help customers not only raise revenue in the top line, but cut costs. You're talking about taking out legacy infrastructure that may be costly to maintain, costly to patch, costly to modernize, and we can help them do that less expensively.
Even right now, as some of the major tech companies are identifying where that revenue is going to come in from, even if there is an outlook that looks solid or sustainable, they're still looking across their headcount and making some of those either freezes or reductions. Where is Okta at in that kind of headcount and the resources that are necessary in order to hit some of the targets you've set forth?
We're consistently over the last few years and over the next few years, we're investing for growth. We are on target for our commitment to be at $4 billion plus of revenue by FY26. That includes growing at least 35% each year in revenue. And so that's going to take investment and that's going to take people. People are at the heart of our products and what we do for customers and how we make them successful. And one of the things about some of these hiring changes you've talked about is it gives us the chance to go out and hire talented people and bolster the amazing team we have. The labor market, as you've covered so well, has been pretty tough the last few years. And I think one of the silver linings in some of this economic uncertainty is that I think the labor market might get more flexible and it gives us the chance to bring on even more amazingly talented people on our team.
Todd, just the tone change in tech land has been stark the past month. For hiring freezes, less growth when it comes to hiring. Looking longer term, how do you think these decisions will impact the longer term future of your company? Not necessarily you're pulling back on hiring, but how does it impact your company and then tech more broadly?
Well, I think that you have to take a long-term view, and we're all about this at Okta. We know these trends of digital transformation, having to be secure, having to invest in the future, whether it's better tools and technology for your employees to make them more productive, making it easy to use, or it's investing in your customer experience and connecting with that customer. Those are enduring long-term trends, and market sentiments go up and the news cycle goes around and around.
And we're investing for the long term. And we think what we're providing to customers, this identity platform that helps them accomplish all these critical business objectives they have, are going to be valuable today, next week, next month, and in many years to come.
Okta CEO and co-founder Todd McKinnon, thanks so much for taking the time, taking our questions here.
Let's stay on the theme of what the Federal Reserve did yesterday. The White House has made it clear that the Fed has a big hand in addressing inflation. So naturally, the question is, how does the administration view the big move from the Fed yesterday? Let's bring in Bharat Ramamurthy, Deputy Director of the National Economic Council, who joins us live. And Bharat, it's great to have you on the program. Obviously, the Fed making a pretty abrupt pivot before yesterday's announcement to that more aggressive interest rate hike. How are you kind of thinking about that? We know the Fed has the ability to lower aggregate demand. Thoughts on what you heard from Jay Powell yesterday?
I think what you heard from Chair Powell was similar to what President Biden has been saying, which is that we're in a transitionary phase right now in our economy. We've had a remarkably fast and equitable recovery from a recession under President Biden's leadership. And now we're in a transition phase where we're going to move towards steady and stable growth. And it's going to take a little bit of time to make that transition. But as I've been saying, the analogy I would use is that when we came into office and we were starting a marathon, we were a couple of miles behind some of our competitors, and we had to sprint to catch up. And we sprinted and we've caught up and we've actually taken the lead, but you can't sprint the whole marathon. You got to find a good steady pace that you can maintain over time, and that's the period that we're in now.
And the suggestion from the Fed chairman, certainly that, it's not like we're going to see inflation go back down to 2% tomorrow as a result of that move. But broadly speaking, the conversation has kind of shifted from, okay, yeah, well, inflation could tilt us in a recession, but so could an aggressive path of rate hikes from the Fed. Is that something that you and the White House are worried about?
When you look at the economy as a whole, we're in very strong position. Consumer spending remains robust. Business investment remains robust. The unemployment rate, of course, is 3.6%. It's an extremely strong and resilient labor market, and not at all what you would necessarily have projected a little while ago. Remember, when we took office, the projection was that we would have 5% unemployment for years to come. It would take a long time to reach the point that we're at now. So we think that we are well positioned to handle what are, truthfully, a number of headwinds, most notably the Russia-Ukraine conflict, which is sending energy prices through the roof and affecting the prices of other commodities like wheat and other food products. So there are significant headwinds. I don't want to downplay that, but it is thanks to the president's economic recovery plan that we in the United States are better positioned to face those challenges, frankly, than many other countries.
Bharat, it's Akiko here. There are questions about to what extent the administration can move on anything in the face of this inflation, how much of that you can actually control. And we did see the president yesterday put out this letter addressing it to the major oil companies, calling for increased refinery capacity and output in the near term. I realize publicly this is what the president has said, but when you look at the broader market, I mean, if you're looking at a 5-year, 10-year timeline, the market is clearly moving away from fossil fuels. So how do you make the case for adding new capacity in the face of that?
Well, look, I think I want to provide a little bit of context on this. If you look at energy prices, which are obviously playing a massive role in the inflation that we're seeing, fully 50% of the headline inflation that we had last month was because of energy. And where we were at the beginning of this year, before Putin's aggression in Ukraine, we were looking at global price of oil of about $70 a barrel. That shot up since those actions up to $120 a barrel. That's a big part of the story. Another big part of the story is what's happening at the refiner level. You know, when we had $120 barrel oil before, prices at the pump were $4.25. Now they're about $5. And so that 75-cent delta comes down to the higher margins that we're seeing at the refinery level. As the president called for in his letter yesterday, he wants to put any creative ideas on the table that we can to expand refinery capacity in the short term. And as you said, there may be arguments for why in the long term we need to transition away from fossil fuels. But there are also maybe opportunities for us to expand refinery capacity in the short term in a way that makes sense for the industry and makes sense from the government's perspective. As the president said, he's open to using authorities that we in the government have to help ease that path. If the companies can put on the table a set of policies, a set of ideas that are viable from our perspective.
When you look at the surge in energy prices, it certainly put the president's climate agenda, at least publicly, in a very tricky position. And I know the president tomorrow hosting a forum on energy and climate. And, you know, I wonder how you tackle the messaging. I mean, on the one hand, you hear the president talking about increasing refinery capacity. You've got the president making the visit to Saudi Arabia to get more capacity output as well. And yet that's inevitably going to increase emissions as a result. I mean, how do you balance those two agendas?
Well, look, I think it's always been a slightly more complicated story than people have made it out to be. I think in the long term, the president has been entirely clear that we need to transition away from fossil fuels to clean energy. And I think the events of the last year or so have underscored that, have underscored why from a financial perspective, in addition, and a national security perspective and a climate perspective, it's important to move away from fossil fuels to clean energy. But it was never the idea that we were going to do that overnight. It's just not feasible to do it that way. And oil and other fossil fuels are going to be a part of our energy mix for some period of time, for some years to come. That was always part of the plan as well. So yes, we have to figure out how to manage that transition effectively. I think what we saw was a massive drawdown in refining capacity in 2020 when demand for oil and gas went down. But it's been very slow to recover. And I think if we look at it financially, for those companies, it's been very potent. The big oil companies, the top five, have made $35 billion in profits in the first quarter of 2022. And they're sending a lot of that back to shareholders rather than reinvesting in production. What we are trying to do is figure out in the short term and the medium term, how do we bring more capacity, refining capacity back online so that we bring down some of those margins and provide relief to consumers at the pump. And at the same time, we do need to work on transitioning away from fossil fuels in the long term. And the president has put forward a climate package to Congress that he hopes that they act on.
So I guess then to drill down on that point again, is that a contradictory message to send, that you would want to turn on more refineries and do more production at the same time you're trying to lower the amount of environmental impact of all of this? How do the other world partners factor into this as well, given the interest in President Biden having a conversation with Saudi Arabia and other oil-producing nations?
Well, look, we've been clear that oil was going to be a part of our energy mix for some time to come. Already, we've seen more domestic oil production last year than we did in the first couple of years of the Trump administration. The projections are that we will have more domestic oil production next year than we've had in any other year in our history. And so we think that there is a business case for increasing refining capacity. And as we said, if there are things that the government can do to make that business case a little bit stronger, we are open to considering them, because this is a critical way of providing relief to consumers at the pump. And the number one priority that the president has is tackling inflation, providing relief to American consumers, and we think that this is a big lever that we have to do that.
Finally, Bharat, I'm noticing you're wearing a green tie. I can't let you go without asking about the NBA Finals. Brian and I have been watching your Twitter feed. The Celtics are on the ropes. They're gonna avoid are they gonna avoid elimination today?
Well, look, I'm glad that you noticed. I did wear my green tie as I'm trying to do my small part in cheering on the Celtics. I am confident about tonight's game. The Celtics have been a very resilient team, as resilient as our economy, for me to stay on message. And I'm hopeful that they're going to bounce back in Game 6, and then you never know what could happen in Game 7.
All right, well, we'll see. Hopefully no downturn for the Celtics. I would personally like to see Game 7. Bharat Ramamurthy, Deputy Director of the National Economic Council, thanks so much for stopping by this morning.
It's hard to find a good deal on new or used cars. Meanwhile, monthly car payments hit a record of $712 a month in May. And that's before you add in the record high gas prices at a national average of over $5 a gallon. So is now the time for electric vehicles to shine? Well, I'm joined by David Underkoffler, Editor-in-Chief of Autolist, and our very own reporter, Pras Subramanian, to find out. So we're going to start with this survey that your company came out with. EVs apparently still not cutting it for consumers, but it's due to price, range, and poor charging infrastructure. Break that down for us.
Yeah, that's right. So we asked consumers over the past few months, what are the top three reasons, pick top three reasons you wouldn't buy an EV? And those are the three reasons people chose. And we've run this survey for a number of years, since 2019, 2020. We took 2021 off, but ran it this year as well. And yeah, those have always been the top three. Consumers are very consistent. Price is the number one reason they're not buying an EV. Range is the second reason. And then charging infrastructure, anxiety over where they're going to charge the vehicle is always number three.
Hey, so this is Pras here. So are people not willing to pay a premium then for those EVs, or they want to just basically they want to have EVs kind of cost the same as those gas-powered equivalents?
Yeah, that's exactly it. They're looking for price parity. When we ask people, okay, how much more would you be willing to spend for an equivalent EV versus its gas price counterpart, the most common answer was no more, right? So there's interest in EVs. We certainly see that on our search traffic and inventory. As gas prices go up, you see more people looking at EVs. But once you get them to that point where they need to spend more for that vehicle, they're not willing to do that.
So then, is it just that the EV market hasn't done a good enough job of really sort of helping consumers understand the upfront cost versus some of the longer term benefits?
I think that's some of it, certainly. Yeah. There is certainly something to be said for the long-term service life of electric vehicles. There's far fewer moving parts in these things, so they need a lot less service over the lifetime of the vehicle. But in our experience, looking at how consumers are imagining this purchase, they aren't necessarily taking sort of the long view. They're looking at sort of the upfront, the monthly payment, and they're not factoring in insurance costs or service costs. So that's sort of where we're seeing that difference.
Hey, David, so what's getting a lot of play this recent times is high gas prices. You guys asked your survey respondents about that. How does that weigh in the factor into choosing an EV versus a gas-powered car?
Yeah, this was a little bit of a surprise for us. The number one reason, so we asked people, okay, what dollar per gallon would the price of gas need to hit in order for you to then to consider an EV for your next vehicle? And the most common answer was actually, it's not about the price of gas. I wouldn't choose an EV for other reasons. And those go back to the reasons we mentioned at the top of the segment: price, range of the vehicle, and where to charge it. So it's, one might think, okay, I'm sitting here, I'm in California, gas is $7 around the corner. $7 a gallon, but there's a disconnect as I'm pumping that gas into my vehicle, it doesn't mean that I'm going to then run around the corner to my dealership and buy an electric vehicle. That's not how consumers are seeing it.
And obviously people trying to sort of figure out how to spend their money right now and what they should be holding on to. But then you also have things like tax incentives for things like EVs that were very popular. You see some countries cutting these subsidies like China. What sort of incentives would really make more people want to get EVs?
Yeah, so we asked people this question sort of two different ways. One, we asked, are you in support of more state, federal, and local incentives to buy EVs? And there was pretty widespread support for that. It was about 2/3 of people, 65%, said that they supported that. But then we also asked, do you support lifting the current cap of every automaker gets 200,000 vehicles that are eligible, that's either electric vehicles or plug-in hybrids that are eligible for a federal tax credit. And that support was actually more mixed. So a little bit of disconnect there. You saw just this week that there were some automakers, the CEOs were asking for that cap to be lifted. That's certainly something that would keep up with the markets in Europe and China. You do see more incentives offered there. And I think that the popularity of EVs in those markets reflects that.
Hey, Dave, looking at the types of EVs that people are buying and that they're interested in, or what are you guys seeing in terms of the types of cars they want to get, in particular pickups?
Yeah, so we're seeing some movement in this segment, right? When we first started running the survey a few years ago, even in that short amount of time, there weren't the same number of vehicles or types of EVs that have come to the market since then, right? So you're seeing crossovers are really what we drive, no matter the propulsion, right? Whether it's internal combustion or EVs, we like crossovers in America. We also like trucks. And so those are the two segments that you're seeing a lot of movement. A lot of people are starting to identify them as, okay, I currently drive a gas truck, but I would be interested in an electric truck. What's also notable is that in that time, we've seen a lot of big automakers. Ford as the lightning you're showing right there. That's going to be a really interesting inflection point, because I think that's going to show a lot of people who maybe haven't previously considered an EV that, look, this is offering many of the daily use case benefits of my current truck, but now it's only electric. It's not a big change to their daily lifestyle of using a vehicle.
I will say I'm more likely to dip my toe in with a hybrid than go full electric, but it's mainly because of that charging station issue. If that changes, maybe I'll change my mind. A big thank you there to our guest, David Underkoffler, Autolist Editor-in-Chief. Thank you for joining us, and our very own Pras Subramanian.
Gas prices ticked down a fraction today, but still averaging $5 a gallon for the first time ever. President Biden demanding action in a letter reading in part, "The crunch that families are facing deserves immediate action. Your companies need to work with my administration to bring forward concrete, near-term solutions that address the crisis." Frank Macchiaroli is a senior vice president for the American Petroleum Institute. That's a trade association that represents more than 600 oil and gas companies. Frank, it's good to see you. Thanks for coming on. What's your reaction to that letter from President Biden?
Look, we're pleased that the administration is finally engaging on this important energy challenge that the country faces. But it's their policies that have helped put us in the situation that we're in. You know, from day one, this administration has closed important pipeline projects, shut off access to oil and gas development on federal lands, proposed tax increases on domestic producers competing globally. And so they really need to not just rethink their rhetoric, they need to rethink their policies to help the American people and to strengthen our energy security.
And Frank, what would those policies look like?
Well, here at API, we released on behalf of the oil and gas industry a 10-point plan called 10 in 22 that really gets at these energy security issues. First of all, we asked the administration to issue a 5-year program to open up areas on the outer continental shelf for development of oil and gas. We work on permitting. We tell the administration that they ought to get moving on expediting permitting for critical pipeline infrastructure projects. We also tell the administration that they need to move away from this, kind of underinvestment rhetoric, telling folks that they need to move away from investment in the oil and gas industry. Those are all the, steps that have constricted or restricted supply here in the United States. They've helped, drive prices up. We need to move away from that. And hopefully this administration and Congress takes action now to help the American people.
We know that President Biden obviously has his green plan that he wants, which